Hello everyone and welcome to this all important session where we discuss about one of the most important and almost a certain exam topic of your CA Inter Advanced Accounting, that is amalgamation of companies. Now the accounting treatment for this is given under AS 14 and there is a specific guidance for this in your volume 1. There are a few sums for AS 14 and there's also a separate chapter where you discuss about amalgamation in your, let's say, subsequent volumes. So we will kind of cover both of them and also discuss what all is relevant, what all is important, along with all the relevant questions over here. So let us get started. So when we look at amalgamation or absorption, what does this cover it? Well, there are two notable legal forms that get covered over here. One is absorption. What do you mean by absorption? Let us say there are two companies, A and B. B over here closes and is acquired by A. So basically B is absorbed by A. Like you have Tata and let us say that is Air India, and let us say Vistara. Let us hypothetically Vistara is closing and it is merging inside Air India, and hence that is called as an absorption, where Tata over here is acquiring or absorbing Air India. Air India over here is absorbing, let us say, Vistara. So let us say that is an absorption. Next, you have something called as an amalgamation. Now, when we look at an amalgamation, what happens in case of an amalgamation? Well, there are two companies and both of them close and a new company is formed. So let's say there is a company A, company B, both of them close and a new company, let's say AB, is formed. Hypothetically, let us say there were two companies, Idea Cellular, and then there was a Vodafone. Both of them closed and a new company V, that is VI Limited, was formed. Now over here we can say the new company VI Limited absorbed the business of Vodafone and absorbed the business of Idea, and hence that is a case of an absorption. Now what will be the accounting in the books of the acquirer, where in the first case of absorption there is Air India who is acquiring or absorbing the business of Vistara, or there is V Limited which is absorbing the business of Vodafone as well as Idea. What will be the accounting in the books of these companies? That is governed by AS 14 in the books of the acquirer. Remember, in the books of the selling company kind of closes. Even if it is an absorption, B closes, or Vistara closes, or even if it is an amalgamation, the selling company closes. And in the books of the selling company, the accounting is as per what we say as GAAP, generally accepted accounting practices, where you are closing a company and hence you will prepare accounts like a realization account, and based on that, you will try to prepare your workings. So when we look at amalgamation or absorption, there is also something called as external reconstruction. But for the time being, let's say there's an amalgamation where there are two or more companies liquidate and a new company is formed. It's covered by AS 14. Next is absorption. A purchasing company acquires the business of the selling company and the selling company subsequently liquidates. That is called as an absorption. Further, there is also an acquisition, which is a holding company acquiring a more than 50% stake in the subsidiary, and subsidiary continues legal existence, which is called as an acquisition or a holding subsidiary relationship, which will be done in the chapter on consolidation. Now there is also something called as an external reconstruction. Now what happens in case of an external reconstruction is there's a company which wants to reconstruct, it closes and revamps its operations and kind of goes into a new company. So there is a company A which closes and a new company A is formed. Like earlier there was a bank called as a Shamrao Vittal Bank. It wanted to rebrand as well as restructure. It closed Shamrao Vittal Bank and a new company SVC was formed, and hence that is more of a external reconstruction. Over here a new company takes over the business of the existing company. All the above transactions in the books of the acquirer will be accounted for as per AS 14. Now, what does AS 14 say? AS 14 says that over here, when I acquire control over someone else's company, I need to pay for it. And that payment is called as purchase consideration. In short, we call it as PC. So, PC is payment made to the shareholders, that is owners of the selling company. Now, it is very much possible that if you look at a company like Vistara, Vistara might have a lot of assets, a lot of liabilities. It would have share capital as well. Now, if Tata were to acquire Vistara, it will have to pay off the shareholders, the owners of the selling company, and once it pays off the owners of the selling company, it can acquire control over the business. So whatever it is paying to the owners of the selling company, it can pay in whatever form. It can pay in the form of cash, in the form of shares, in the form of bonds. It can be paying in any form. The payment in the payment to the owners of the selling company is called as a purchase consideration. That is the first step in acquisition accounting. Now, when you look at purchase consideration, this is payment made to the shareholders. Who are the shareholders? Well, equity shareholders as well as preference shareholders. Now, sometimes it might happen that the selling company might also have debentures. Now, in lieu of the existing debentures of Vistara, you might issue your own debentures as well. However, is that payment made to the owners? No, that is a payment made for liability. You can pay off the debentures in cash, or you can even issue your own debentures in lieu of the old debentures. This is called as payment towards acquiring a liability, and hence it will not be a part of the purchase consideration, which is strictly restricted to the payment that you are making to owners, and owners over here are shareholders, and shareholders can include equity shareholders. It can also include preference shareholders. Remember, the payment can be made in cash, in shares, in any form, as long as it is made to the owners. It is very much possible to the shareholders. You issue debentures, that's fine. It is still PC because it is a payment made to the owners, that is the shareholders. Are we clear with this? So over here, when you look at purchase consideration, as per AS 14, PC is defined as the aggregate of the payments made to the shareholders, both equity as well as preference of the selling company. The following points need to be noted while calculating the purchase consideration. First, the payment to the shareholders can be made in any mode, like you can issue their own shares, preference shares, debentures, or even pay cash. Payment to debenture holders or creditors of the selling company will not form a part of the PC, but it will be taken along with the net assets taken over. While determining purchase consideration, the mode of payment is irrelevant. The parties to whom the payment is made is irrelevant. You can pay in any mode as long as you are paying to the shareholders. It will be a part of PC. Now, PC can be calculated in multiple ways. The two of the most common ways are net payments method. That is how much payment you are making. That is the most superior method. If there is an agreed payment, you will take that. Like for example, when Instagram was acquired, was acquired by Facebook. It is now called as Meta. Earlier it was Facebook. Facebook acquired Instagram and they paid $1 billion at billion. Okay, that's close to 8,500 crores. At that time, Instagram hardly 8 to 10 employees. So still Facebook was ready to pay $1 billion. WhatsApp was acquired by Facebook by close to 15 to 20 billion dollars. They had 55 employees. Even the receptionist of WhatsApp actually bought a Lamborghini because the amount of money that they got, 15 to 20 billion dollars. That's bigger than some of the biggest Indian groups like Mahindra, etc. for 55 employees. So if someone is agreeing to pay that, well, that is PC. However, in some questions, and that is very much exam driven, it is not practical, because in practice you will always agree what is to be paid. But in some of the questions, you are not being given how much is a payment. In which case, do you assume that the company is acquired free of cost? No. In such rare cases, you will assume that your purchase consideration is equal to the net assets of the selling company. At least jitne net assets, land, building, machinery, inventory, everything, whatever is the fair value of these net assets. Net asset is assets minus liabilities. You will say that at least utna to pay karna padega. You'll have to pay that much. And as a result, if you don't have data regarding payment as per net payments, only then will you go to the net assets method. So where your purchase consideration can be calculated by the following methods: net payments method, or also called as a net assets method, to be used only if information about net payments is not given. Sometimes the institute also asks you to calculate an exchange ratio using something called as intrinsic value. Intrinsic value is the real value of the share. Like for example, the acquirer, and T is a target. Acquirer share is worth 30 rupees in the market. Target share is worth 15. In which case we will say, well, if I have to find the exchange ratio, you can say that for one share of the target, you can issue 0.5 shares of the acquirer, half a share of the acquirer. So if target has 100 shares, we'll just issue 50 shares, because if target's 100 shares are worth 15 into 100, that is 1500, acquirers 50 shares would also be worth the same. Are we clear with this? So sometimes you might ask to calculate the exchange ratio based on the intrinsic value, and that is the intrinsic value of the target company, that is 15, upon intrinsic value of the acquirer, that is 30, and that will help you to calculate the exchange ratio. 0.5:1, or you can also call it as 1:2. Okay. Now when you look at net payments method would mean it is a purchase consideration based on the agreed payments. Payment can be in any mode. In case payment is made by issuing shares, remember, we will take the number of shares issued, that is what you are paying, into the fair value of those shares. Can be calculated as the number of shares in the selling company into the exchange ratio. Maybe a selling company has 100 shares into 0.5/1 or 1/2, that is equal to 50 shares of the acquirer, and into the issue price of P. Well, the issue price over here will be the market price. If that is available, we'll take that. If that is not available, we will take the face value. So into the issue price of P. In case the exchange ratio is not directly given in the question, then we have been told exchange ratio to be based on intrinsic value, then the exchange ratio can be target upon acquire intrinsic value of S, that is 15, upon intrinsic value of P, that is the acquirer, that is 30, and hence 0.5:1. Now the issue price of P, in case a specific issue price is given, we will take that. Or if no such price is given, then we can take the face value for the purpose of calculation, if it is not given. Further, well, this is rare, but if the number of shares come in decimals after applying the exchange ratio, now we cannot have issue shares in decimal, and hence for the decimal element, let's say you have to issue 15.5 shares, then I'll issue 15 shares and the 0.5 ke samne I will pay cash. Then we will round off to the lower number, and for the fractional, that is a decimal element, cash would be paid. The settlement would happen for the decimal amount in cash. In certain questions, exchange ratio is not given. However, the agreed value to be paid for the entire company is given. So we have been told that for the entire company, yes, you will have to pay 100 crores. Well, how are you going to pay 100 crores if it is going to be paid in cash? 100 crores will be paid in cash. However, if it is going to be issued in shares, then we will have to figure out the issue price of the shares of the acquirer. Let's say it is 20 rupees. Then 100 crores divided by 20, and whatever that comes to, let us say that comes to 5 crores, will be the number of shares to be issued. Okay, next we have net assets method. In case the details on net payments are not given, only then will you go to the net assets. In such case, we will take the fair value of the net assets. It is reasonable to assume that P will pay an amount equal to at least the net assets of S. This calculation, assets and liabilities should be taken over at the market values. In case market values are not given, then we take it over at the book values. Now, before you go to the accounting, we will try a few problems to see if you are able to understand. First, we'll go to our volume 1, where you will do question 1 and question 3 in AS14, and then you will go to your volume 2, where there is the bulk of the questions. So this is volume number 1, where you will review on page number 199, question number 1. Now, A Limited takes over B on 1st April 2011 and discharges consideration for the business as follows. Now, PC is very important. You get standalone questions on PC in a descriptive as well as in MCQ section, and in almost every big question PC will be there. So PC is something that you should be clearly able to calculate. Now, issued 42,000 fully paid equity shares of rupees 10 each at par. At par means at face value to the equity shareholders of B. This is a part of PC. So this is 42,000 into 10, and hence this is 4,20,000. Further issued fully paid 15% preference shareholders, preference shares of rupees 100 each to discharge the preference shares 1,70,000 at a premium of 10%. What is written? Issued fully paid preference shares to discharge 1,70,000 worth of preference shares at a premium of 10%. So for 1,70,000 worth of preference shares, we are issuing 1,70,000 plus 10%. Can I say 1,87,000 worth of new preference shares will be issued? This will also be a part of PC because this is a payment made to preference shareholders, and any payment made to shareholders, equity or preference, will be a part of PC. And then it is agreed that the debenture holders of B will be converted into an equal number and amount of 13% debentures of A. Now this is a part of net assets. This is not a part of PC. So we will say for 50,000 worth of debentures, we are issuing 50,000 worth of our debentures. So we are agreeing to take over a liability worth 50,000. Determine the amount of purchase consideration as per AS14. So this would be 4,20,000 and 187, which will come to what? I believe this will come to around 6,07,000. So over here, your total will be 6,07,000. Question number 1. Next, we go to question number 3. Over here, let's say question number 3. Now, Astha Limited is absorbed by Nishtha Limited. So Astha is the target, Nishtha is the acquirer. Consideration being the takeover of liabilities, the payment of cost of absorption not exceeding 10,000, and actual cost is 9,000, and the payment of 9% debentures of rupees 50,000 at a premium of 20% through 8% debentures issued at a premium of 25% of the face value. So for taking over debentures, you are agreeing to issue your own debentures. There is some premium discount over here, and the payment of 15 per share in cash, an allotment of 11% preference shares of rupees 10 each, and 4 equity shares of rupees 10 each at a premium of 10% fully paid for every 5 shares of Astha. Now this I would say is a part of PC. Upar you may be taking over liabilities. Your trade payables are my trade payables. whatever is the cost of acquisition I will pay, but all of that is not a part of BC. BC is a payment made to shareholders, not payment made to liquidators, not payment made to debenture holders, not payment made to creditors. The number of shares in the vendor, that is the selling company, are 1,50,000 of rupees 10 each, fully paid. Calculate the purchase consideration as per AS 14. Now as per AS 14, you have been told that your PC will comprise of cash paid, which is 15 per share in cash, 15 into 1,50,000. An allotment of 3 preference shares of rupees 10 each and 4 equity shares of rupees 10 each at a premium of 20% for every 5 shares in Astha. So over here is 22,50,000 of cash. However, to the equity shareholders only, you are issuing preference shares, and that is how much? For example, for every 5 shares, you will issue 3 preference shares, and every preference share is of rupees 10 each, and hence this is 1,50,000 into 3 by 5 into 10. Maybe this is 9 lakhs, and I will further issue equity shares as well. That is 1,50,000 into, I believe, 4 by 5, and hence this comes to, I think, 1,20,000 shares, and this is at 12 rupees. 12 rupees at a premium of 20%. So 10k badle 12 rupees. So this will be what? 120 into 12 comes to, I think, 14,40,000. And hence if I total all of these, plus 9 plus 2250, 45,90,000. So this will be 45,90,000. Are we clear with this? Yes. Okay. So this is regarding the 2 questions over here. We'll also go to our volume 2 and try to discuss a few questions over here. Go to question number 1. Most of these questions are PC questions. So we have mentioned the last day revision questions over here. So let us review question number 1. Let us consider the draft balance sheet of X as on 31st March 11. So you have the draft balance sheet, and last में देखो क्या पूछा है, compute the PC. So what is there? Y takes over X on 10th of April 2011. So Y is the acquirer, X is a target. You have been given the balance sheet of X. Debenture holders of X are discharged by Y at a 10% premium by issuing 15% own shares of Y. This is a part of net assets taken over, not a part of PC. 14% preference shares of X are discharged at a premium of 20% by issuing necessary number of 15% preference shares of Y. Again, 14% preference shares of X, here you go, are discharged at a premium of 20%. So for this, you are going to pay 20% more. So 2,500 plus 20%, I think this will come to 3,000, and this will be a part of PC by issuing requisite number of preference shares of Y. So maybe 3,000 in thousands divided by 100 rupees. So this is 30,000 preference shares of rupees 100 each. An intrinsic value per share of X is rupees 20, and that of Y is rupees 30. Y is the acquirer, X is a target. Y will issue equity shares to satisfy the equity shareholders of X on the basis of intrinsic value. So Y will say that my share is worth 30 when your share is worth rupees 20, and hence for 750 shares that you have, these are worth 20. In return, I am issuing you shares which is worth 30, and hence these are the number of shares to be issued. 750 into 20 divided by 30 comes to, I think, 500, and these are shares of Y. Ideally they are issued at the issue price, but they have told you that however the entry should be made at par value only, and hence we will say that the par value of this share is 10. Otherwise I would have taken 30 over here. The nominal value of each equity share of Y is rupees 10, and hence this is what? 750 into 20 by 30 into 10, and hence this comes to 5,000. So if I had to calculate the PC, I believe your PC would be, I think, 8,000. So over here, if you go to see, just a second, if I can just pull this up, where do we have? Just a second. Yes. Okay. I think we've done this directly. Question number 1. You can see 3,000 as well as 5,000 over here, and hence the total comes to 8,000, which is PC, and we will just mention that payment to the debenture holders is a part of net assets and not a part of PC. Are we clear with this? This is question number 1, basic question. Next we go to question number 2. S Limited absorbed P Limited. Again, S is absorbed by P Limited. S is a target, P is the acquirer. Draft balance sheet of S is as under. You have been given sundry assets, then 2,000 7% preference shares of rupees 100 each, 5,000 equity shares of rupees 100 each, and you have this data. P has agreed to issue 9% preference shares of rupees 100 each in the ratio of 3 shares of P for every 4 preference shares of S. This is a part of PC because it is payment made to the preference shareholders. For 2,000 preference shares, they have said we will issue 3 shares in P for every 4 preference. I'm sorry, I think there was some interruption. So we were saying point number 1, we are going to issue 9% preference shares of rupees 100 each in the ratio of 3 shares for every 4 preference shares in S. So for 2,000 preference shares of S into 3 by 4, that is 1,500 into 100, and hence I would say that will come to 1,50,000. That is very much a part of PC. Next, to issue debenture holders in S 8% mortgage debentures of 96 in lieu of 6% debentures, which are to be redeemed at a premium of 20%. We'll skip that. Why? Because this is a part of net assets and the question says calculate PC. Okay. Next, to pay rupees 20 per share in cash and to issue 6 equity shares of rupees 100. Market price is 125 in lieu of every 5 shares in S. So for equity shares, I will have a cash payment, which is I think 20 per share. So this is 20 into 5,000 comes to I believe 1 lakh. And then you are also issuing equity shares. Issue 6 equity shares in lieu of every 5 shares. So this is 5,000 into 6 by 5 will come to 6,000 shares, and every share is worth 125. You have not been told over here that this is going to be at the face value only, and hence this will be 6,000 into 125 comes to I think 7,50,000. And hence, if I total all of this, assume liability of trade payables, this is also part of net assets. So if you look at your PC, that is 1,50,000 and 1 lakh, that is 2,50,000 and 7,50,000. So that comes to a total of 10 lakhs. Straightforward. Okay. Next, we will go to question number 3. Now, Y decides to absorb X. Y is the acquirer, X is a target. The draft balance sheet of X was as follows. You have the net assets, 3,000 shares of rupees 100 each, preference shares, and P&L debit balance. Now Y agrees to take over the net assets of X. An equity share in X for this purpose, for the purpose of absorption, is valued at 70. So we have agreed that for every share of X, we will agree to pay 70. 3,000 into 70, that is maybe 2,10,000. Y agrees to pay 60,000 in cash for payment to preference shareholders. Equity shareholders will be issued at the value of rupees 120 each. Calculate the purchase consideration to be paid by Y and how will it be discharged. Now, purchase consideration is payment to preference shareholders, that is 60,000 in cash, and then payment to equity shareholders. So when I look at payment to equity shareholders, we have agreed that for the purpose of absorption, shares are valued at 70, and hence we will say this is 3,000 into 70. Can I say this is 2,10,000? And how will this be discharged? Well, 2,10,000 shares of rupees 120 each. 2,20,000 divided by 120. So this will be probably 1750 equity shares at the rate rupees 120 each. And hence your total PC will be, let's say, 2,70,000. Your total PC will be 2,70,000. So we'll just verify that once. If you look at question number 3, this is 60 and 2,10,000, that is 2,70,000. Okay, fairly basic problems. Now question number 4 is the question which is a last day revision question. Similar question has even come in the exam and is also there in your practice section. So we'll review question number 4. There are a few additional data points which the institute has removed from its study material, and hence we will also ignore the same. So over here, Neil and Gagan, we are doing it the way it is there in the institute study mat. Neil and Gagan amalgamated to form a new company on 1st April 2011. Following is a draft balance sheet of Neil and Gagan as on 31st March 11. Okay. Now, following are the additional information. Now, this 2 points, you can read. But this has been deleted by the ICI. In any case, this is not relevant in PC calculation. Would have helped if you had to go into an entire balance sheet preparation. So Institute has removed it because this data was irrelevant and was creating a lot of confusion. So you can very safely remove this as well. It is not there in the study material even if you see the same sum. Then you have point number 4 say start hoga, the assets of Neil and Gagan are to be revalued as under. Plant and machinery 525, building 775. For Gagan is as well, you have been given the fair values. The purchase consideration is to be discharged. Now when you look at the capital, there seem to be 775 and 855 and also some reserves. Capital, current, no, this is current liabilities actually. The purchase consideration is to be discharged as under issue 24,000 equity shares of rupees 25 each, fully paid in proportion of their profitability in the preceding 2 years. So to Neil and Gagan in the ratio of their profitability. Now profits for the preceding 2 years are, so the first year and second year for Neil and Gagan. So if I total this up, 475 and 525, this will come to 10 lakhs in total. So can I say, if I were to look at the PC, out of the 24,000 shares to Neil and to Gagan, I can say 24 into 475 upon 100 and 24 into 525 upon 100. So this is 24,000 into, can I say 11,400 shares and 12,600 shares. Okay, these are of rupees 25 each. So this will definitely be a part of PC. Now this is easy. The difficult part will be for this. Issue 12% preference shares OBT of rupees 10 each, fully paid at par to provide income equivalent to 8% return on net assets on the business as on 31st March 11 after evaluation of assets of Neil and Gagan respectively. Now what is it written? It is saying that you are issuing 12% preference shares at par to provide an income which is equivalent to 8% return on net assets. So this is providing an income equivalent to 8% return on the net assets in the business as on 31st March 11 after evaluation of assets of Neil and Gagan respectively. Okay, so over here if I look at Neil, plant and machinery is 525 and building is 775. Okay, is there any other asset? Yes, current assets of 163,500. So if I look at the net assets of Neil, this would be 525 plus 725, 775 rather, 775 plus 163,500. That is total assets, not net assets. You look at the liabilities. Does Neil have any liability? Yes. Minus 623,500 will be the liability. So 8,40,000. Now 8,40,000 is the net assets of Neil. Return on net assets after revaluation is 8% into 8%. This comes to 67,200. Now they say that you will issue preference shares in such a way that the return on the preference shares, that is preference dividend, will equal to 8% of the return on the net assets, and hence I can say that, well, this has to equal to the preference dividend, but preference dividend is at the rate of 12%. So if 67,000 is 12%, then 100 is how much? Can I say 5,60,000? Okay, you can pause and try to do the same working. Let us say for Gagan on your own, if you go to see for question number 4, which is an important question, we look at the payment to the shareholders. Over here, the payment is first in the form of 24,000 shares which are distributed. 24,000 are distributed in the ratio of profitability. So out of 24,000, 11,400 goes to Neil. The remaining 12,600 at the rate of rupees 25 goes to Gagan. Next, you want to find how much are the preference shares issued. That is in such a way that the income on these preference shares will be equal to 8% of the return on net assets. So if I look at the return on net assets, 8,40,000 was our net assets. 8,40,000 into 8% will come to 67,200, which will be the preference dividend. So if 67,200 is equal to 12%, then 100 is how much? Which is 5,60,000. And hence that is a part of your PC. 5,60,000 at the rate of rupees 10. This is 56,000 shares of rupees 10 each. And hence 285 and 560. This is 845. Are we clear with this? This is 845. A similar working will be done for Gagan. If I go to see for Gagan, just for reference, 675 plus 648 plus 158 600. This will be total assets minus 557 600. This will be the liabilities. 9,24,000 will be the net assets into 8%. 73,920 divided by 0.12. 6,16,000. If I go to see, all said and done, 6,16,000 will be the preference shares to be issued. Are we clear with this? Yes? Okay. So this takes care of your question 4 as well. So these are by and large questions pertaining to PC. There are also a couple of other questions, but before that, we will go into further understanding of our accounting. Now, let us say you have calculated the purchase consideration. Usually the next step involves calculating net assets that you are taking over at usually the fair values. However, at what value should you take over net assets? That depends on the method of accounting to be followed. As per AS 14, there are two methods of accounting which are possible. First, there is something called as amalgamation in the nature of purchase, for which you will follow acquisition method, and then there is amalgamation in nature of merger, which is more like a restructuring or a reorganization, in which case you will follow pooling, POOLING, pooling or joining of interest method. So how would we figure that out? Well, there are around 4 conditions which are given for accounting something as amalgamation in the nature of merger, and if these conditions are satisfied, then it is amalgamation in nature of merger. But if they are not, then this should be treated as amalgamation in nature of purchase. Now the problem is, in most of the questions, the institute will not tell you whether it is amalgamation in nature of merger or in the nature of purchase. Like in question 1, 2, 3, we just had to find BC, but it was nowhere told whether it is in the nature of merger or it is in the nature of purchase. Now in the exam, what institute consistently does, even in the study material and in general, is if nothing is given, we will always assume an acquisition to be in the nature of purchase. Only if the question specifically tells you that this is a merger, or it tells you that pooling of interest method is to be followed, only then will you go into the amalgamation in nature of merger. Otherwise, you will always solve considering it to be amalgamation in the nature of purchase. Are we clear with this? Now, what are the features of amalgamation in the nature of merger? So over here, the features of amalgamation in nature of merger are, in case of merger, there is merely a pooling, that is joining or adding of assets or liabilities or reserves of a purchasing and selling company. So features of amalgamation in nature of merger, in case of a merger, there is merely a pooling, that is joining or adding of the assets, liabilities or reserves of the purchasing or the selling company. Conditions for a merger: all assets and liabilities of the selling company are taken over at book values. So this is one of the conditions. Now usually, if there is an actual purchase, will you give up the assets and liabilities at book values or at fair values? You will charge the fair values. The land might be purchased by you 50 years back at 100 rupees. Today the market value is 1000 rupees. If you had to transfer this land, you will usually transfer it at fair values. However, if you are just reorganizing, like transferring from one of the subsidiaries to the parent companies or one subsidiary to another subsidiary, you are just reorganizing. In which case, can you transfer it at book values? Yes. So if assets and liabilities are transferred at book values, first condition for a merger. Second, at least 90% of the shareholders of the selling company will continue to be shareholders of the purchasing company. So purchasing, like for example, there is Geo India Limited. It has a subsidiary Geo South. It has a subsidiary Geo North. In both of these companies, let's say they come together and they do a merger, Geo South and Geo North. Can I say 90% of the shareholders of these companies are the same? Yes, and hence one can say that, well, Geo North and Geo South are coming together, but at the end of the day, they're just reorganizing. And hence, 90% of the shareholders have to be the same. Now, in most of the questions, we don't know who the shareholder of P is, who the shareholders of S is. And hence, we cannot solve considering amalgamation in nature of merger unless it is otherwise given. We'll assume it is in nature of purchase. Next, purchase consideration should be discharged in the form of shares only. That is, there should be no cash or anything in the same proportion as the old entity, and the business of the selling company is intended to be carried on in the same form by the purchasing company. Now, if these four conditions are fulfilled, then it is amalgamation in nature of merger. And if it is in the nature of merger, then you follow pooling of interest. It's a very special method of accounting which we will do later. If these conditions are not followed, or if the question remains silent, we will always solve using amalgamation in nature of purchase, which is a very logical method where you will calculate purchase consideration based on the fair value of the shares issued, net assets based on the fair value of the assets and liabilities taken over, and what if there's a difference between the purchase consideration and the net assets? Is it possible that there's a difference between purchase consideration and net assets? Yes. Then how will you account for it? Well, if the purchase consideration was 100 and the net assets taken over are 80, why will I pay 100 for something which at fair value is worth 80? It is because I'm acquiring a business, and big business has a reputation, and hence the 20 will be attributable to goodwill. On the other hand, if the PC is 100 and the net assets are 110, now for something which is worth 110, I'm paying only 100, so I'm getting a bargain, and hence 10 rupees is my gain. But this is a gain on purchase, and hence it is a special transaction, and hence rather than taking it to the P&L account, I'll take it to a special account called as a capital reserve. So the difference between purchase and purchase consideration and net assets in case of a acquisition method or a purchase method will be taken to either goodwill or to capital reserve. Are we clear with this? However, if it is a pooling of interest method, you are just joining two of your subsidiaries, they are just joining together. Now, it is like saying that I have two flats. I don't have it, but let us say I have two flats next to each other. Both of them are 2 BHK flats, and there's a wall in the middle. Now, what I do is I break that wall. Now, when I acquired those two flats, they were worth 50 lakhs and 50 lakhs each. Today, each of these flats are worth 2 crores each. Can I say I'm acquiring a flat worth 2 crores? No. Can I say I'm just joining or pooling my interest which was there in two flats and joining it into a single flat? Yes, and hence it is now instead of two separate flats of book value 50-50 each, there's one big flat with a book value of 100 each. However, if I did not have my neighboring flat, I acquired the neighboring flat from my neighbor, I would have actually paid 2 crores for that flat. Now can I say that if I'm absorbing, then I have paid 2 crores for that flat? Yes, at fair value. But that is a purchase method. When you're acquiring from someone else, 90% of shareholder is not the same. It is held by your neighbor, not by you. Are we clear with this? Okay. So when you look at pooling of interest method, assets and liabilities will be taken over at book value. In purchase method, assets and liabilities will be taken over at fair values. Okay. In case all of the above conditions are satisfied, amalgamation would be accounted in the nature of merger. If any of the conditions are not satisfied, amalgamation will be accounted in the nature of purchase. In the exam, if nothing is specifically given, we will do accounting in the nature of purchase unless it is specifically given that it is in the nature of merger. Now, what are the features? This is more important from an exam perspective. Amalgamation in the nature of purchase, you will account it using the acquisition method where assets and liabilities will be taken over at fair values. Reserves will not be taken over. Remember, reserves are not transferable item. मेरे को mood हुआ, can I transfer land and building? Yes. I can transfer land and building to someone else. But मेरे को mood हुआ, can I transfer reserves to someone else? No, reserves are not transferable. I cannot transfer P&L balance if I want to. And hence usually reserves will not be taken over. However, assets and liabilities will be taken over. And the difference, if any, between the purchase consideration, let's say 100, and net assets, let us say, is 80, will be either goodwill or capital reserve. But if it is pooling of interest method, pooling is joining of interest method, then assets and liabilities will be taken over at book values. Reserves will be taken over. Why? Because Geo Limited had more than 90%, let's say in Geo South, it also had in Geo North. If both of them are coming together, ideally reserves are not transferable, but that is someone else's reserves cannot be transferred to me. But can I say in essence, these are my offshoots or my companies only, and hence when I'm joining them, it is more of a reorganization or restructuring, and hence reserves as a special case are allowed to be taken over in case of pooling of interest method. And if there's a difference between the PC and net assets over here, including the reserves, you cannot adjust the goodwill. Why? Well, goodwill is if you are acquiring someone else's reputation. Now, Geo South, Geo North are your companies only. You cannot say that you are acquiring your own reputation. That will be self-generated. And hence, this difference will be taken as capital reserve or adjusted in reserves. You can adjust it in general reserve as well. You will not create a goodwill for this. So, the difference, if any, between PC and net assets, there is no goodwill or capital reserve. Difference is to be adjusted in general reserves or any other reserves. We will do sums on that. But at least to have clarity, we will at least do one sum which involves this. So over here, what are the steps for accounting for amalgamation or acquisition using the purchase method or acquisition method? First is calculating the PC. Second is calculating the net assets. This is at fair values because you are using the acquisition method. Market values in case they are given, and if they are not available, then book values. And then step 3 is the difference between goodwill, difference between PC and net assets, that is equal to goodwill. Now step number 1, PC will be done every time. However, step number 2 may be skipped in case you are asked to pass journal entries. If you are asked to pass journal entries, in the journal entry, you will take over assets and liabilities. And hence, your balancing figure will automatically be found. If you do step 1, 2 and 3, no problem. However, if a journal entry is passed, in the journal entry, when you take over assets and liabilities, automatically the balancing figure, you compare assets and liabilities with the purchase consideration, the balancing figure will be goodwill. We will see that. So you can skip that. And usually, in the 4th step, they usually ask you to prepare the balance sheet. The balance sheet again has to be prepared in the Schedule 3 format. So over here, you'll prepare the balance sheet. Sometimes you're asked to pass journal entries. Now, journal entries can be of 2 types. First, we call this loosely as acquisition entries. Now, acquisition entries would be when you are acquiring the business. Let's say your PC comes to 100 rupees. You'll say business purchase account debit to liquidator of S. So we are saying that to the liquidator, I'll have to pay 100 in lieu of the business. So business purchase account debit to liquidator of S. This is by the PC amount. First entry. Next, you can pay the liquidator. So liquidator account debit to, in whatever form PC is to be paid, to equity share capital, to preference share capital. If there's a securities premium, then securities premium, to cash, whatever it is. So you will pay off the liquidator. So liquidator, which was a temporary account, will now cancel, and whatever are the shares issued are done. However, in lieu of issuing the consideration, you will get a business, and business is worth assets and liabilities. So you will take over assets, debit the assets that you are taking over. You will also take over the liabilities, credit the liabilities. Okay, but now this represented the business. So ये जो आपने business purchase debit करके रखा था, now that is no longer required. You are saying that I am waiting to purchase a business. I have agreed, but I have not yet acquired. Now I have acquired. So the temporary account of business purchase will now be credited. And hence, this is where you are comparing. In red, what I have highlighted is the net assets taken over, step number 2, जो हमारा होता है. And in green, what I have highlighted is the business purchase, what is usually our step number 1, PC. And the difference between these will go to goodwill if it is appearing on the debit side. Will go to the capital reserve, it is appearing on the credit side. Are we clear with this? So we have mentioned that in case journal entries are asked, then we can pass the above entries and we can skip the net asset working and the goodwill working and directly show the journal entries. Since the effects will be considered directly, the balancing figure will automatically come. But remember, you will have to calculate PC. Now, apart from that, there may be a few other adjustments that may be required. Now, what are the adjustments? First, your adjustment may be involving let us say intercompany receivables or payables. It is possible that P had some receivables for goods sold or whatever it is from S. S had some payable. Now, earlier they were 2 separate entities. Now both of them are together. So will I still continue to show the receivables and payables? No, I will eliminate it. So receivables will be credited and payables will be debited. So over here, adjusting entry, these are additional adjustments which might be given in the question. The general effects are as follows. Intercompany debtors or creditors can also be bills receivable, bills payable, can also be loans given, loans taken. We should first take over the intercompany debtors and creditors and then pass the entry for elimination. First, over here as a part of this entry, you will take over all assets and all liabilities and then I will eliminate it. So this is creditors account debit to debtors, bills receivable and bills payable should also be eliminated in the same manner. However, sometimes it is possible that the bills have been endorsed or discounted, in which case I cannot eliminate it, because if the bills have been endorsed, then the payable is not to be paid to the drawer, it is to be paid to the creditor, and hence there exists a liability. Now there can be sometimes a case where P has sold goods to S. Now selling price of these goods was 120, cost price of this good was 100, and hence P would have recorded a profit of 20. Now in the books of S, the inventory will, let us say, appear at 120. Now I will take over this inventory at 120. However, the true cost of this inventory for P was 100. 20 was booked as a profit, but because of the acquisition, had there been no acquisition, that 20 is realized profit. Because of the acquisition, that profit now is kind of questioned, because I'd sold goods, I was happy कि चलो 20 रुपए कमा लिया, but those goods have come back to you, and hence we will eliminate unrealized profit. So inventory will be credited, stock will be credited. What will be debited? Someone says P&L account. Well, usually you could have debited the P&L account because 20 would have gone to the P&L. However, this 20 is now maybe unrealized, not because there was a sale return or anything in the ordinary course of business, but a special transaction like amalgamation or absorption. Because of that, this 20 is no longer realized, and hence you will adjust it against goodwill or capital reserve, which is a cost that you are bearing because of the acquisition. So take over the inventory at full value, that is 120, and then unrealized profit on stock would be eliminated either through goodwill or capital reserve. This is because profit needs to be reversed due to amalgamation. Due to amalgamation, and the cost of amalgamation is 80 rupees goodwill, or gain on amalgamation was the capital reserve. And hence the unrealized profit would be adjusted against the goodwill and capital reserve, not against the P&L. This is the cost or gains on acquisition. Similar is the case of liquidation expenses. Because of amalgamation, you have to close the other company, and hence for that you will have to make a payment. This also increases your cost of acquisition, and hence this will be separately adjusted against the goodwill or capital reserve. In case P pays for the liquidation expenses of S, the entry would be goodwill or capital reserve account debit to bank. Again, these expenses are directly attributable to the acquisition, and hence they should be adjusted against the goodwill or capital reserve. Next, there can be something called as the statutory reserve. Examples of this may be like export promotion reserve, export profit reserve, investment allowance reserve, development rebate reserve. These are reserves which are required as per a law or a statute. Now, S had to maintain these reserves for 5 years. 2 years have gone by, 3 years are remaining. However, now S closes. But as per law, you have to maintain this for 5 years. So P will maintain these reserves over the next 3 years. But P cannot take over the reserves because the reserves are not going to be taken over. So P will separately create a reserve after the acquisition. So you will credit the reserve and debit something. Well, what will you debit? You will debit a special account called as an amalgamation adjustment account. So over here, for the statutory reserves, this amalgamation adjustment account is a temporary account which will continue to appear till the time the statutory reserve appears. Once the statutory reserve is no longer required, let's say after 3 years, then you will debit the statutory reserve and credit the amalgamation adjustment account. Till that time, this amalgamation adjustment account or reserve will be shown along with the reserves and surplus. So in statutory reserve, there will be a credit balance in reserves. Amalgamation adjustment reserve, this will be a debit balance which will be shown within the reserves. So these are reserves required to be maintained as per law or as per statute for a specified number of years. As per the purchase method, the reserves of the selling company S cannot be taken over by the purchasing company, that is P. Again, these are reserves required to be maintained as per law or statute for a specified number of years. As per the purchase method, the reserves of the selling company cannot be taken over by the purchasing company. However, in case the law requires, certain reserves of S are to be continued for a specified period of time, then we will have to recreate the statutory reserve in the books of P by passing the following entry: amalgamation adjustment reserve to stat reserve. Examples are export profit reserve, investment allowance reserve, development rebate reserve are examples. Amalgamation adjustment reserve will have a debit balance and will be shown as a reduction in the reserves and surplus note, something like this. So over here there will be a statutory reserve, and next to that an amalgamation adjustment reserve will also appear. Okay, next you have sometimes you saw a lot of adjustments, but हमने ज़्यादा भाव नहीं दिया था पहले of debentures being taken over because we had to only calculate PC. But is it possible that you are also supposed to calculate, let us say, the net assets taken over? Yes, in which case you will say that if debentures of 100 are to be taken over at 120 to be paid at a premium of 20%, then you will say debenture liability to be taken over, for example, at 120. We will take over the debentures at the agreed values and generally settle them by issuing our own debentures. Again, we will take over the debentures at the agreed values and generally settle them by issuing our own debentures. Okay, the journal entries will be old debentures account debit to new debentures. The old debentures debited at the agreed value, new debentures credited again at the agreed values. So you'll first take over the debentures at the agreed value. Then these are debentures of the old company. Now old company does not exist, and hence you will debit the debentures of the old company and then in lieu of that, issue new debentures at whatever is the issue price. We'll do adjustments on this. So based on that, we'll do a few sums. So if you go to question number 5, over here, I think you'll have practice of both amalgamation in nature of merger and in the nature of purchase, both. Let us review 5. In fact, it's an easy question, but you can put this for LDR. I'll just add 5 over here. It's an easy question per se, but you can put this as LDR primarily because such a question helps you in one question to practice a purchase as well as the merger method basic level pe. So let us review this question number 5. Okay, so following is your summarized balance sheet of X and Y. You have been given the balance sheet of X and Y, and then X takes over Y. X is the acquirer, Y is the target. On first table 11, X discharges the BC as below. Issuing 3,50,000 equity shares of rupees 10 each at par to the equity shareholders of Y. So will that be a part of BC? Yes. 35 lakhs, 3,50,000 into 10. Everything is in thousands, so 35 lakhs divided by 1000 comes to what? 3,500. So maybe 3,500 in 1000 will be your PC. And issue 15% preference shares of rupees 100 each to discharge the preference shares of Y at a 10% premium. So what are the preference shares of Y? I think 1700, and if I take 1700 plus 10% premium, can I say this is 1870? So this is your PC, probably 5370. Okay, the debentures of Y will be converted into equivalent debentures of X. So we were earlier conveniently removing it into net assets. Even over here it will be a part of net assets, but here if you have to prepare the balance sheet, you will have to consider even the net assets working. And the stat reserve of Y are to be maintained for 2 more years. You are required to show the balance sheet of X after amalgamation on the assumption that amalgamation in nature of merger, amalgamation in nature of purchase. So if you look at amalgamation in nature of merger, for example, you will take over all assets and liabilities at book values. Now you are not required to pass journal entries, but just for a reference, if you had to pass the journal entries, your entry will be business purchase account debit to liquidator 5370, then liquidator account debit to equity share capital 3,500 to preference share capital 1870. So if you look at this, if I can maybe this is done a little behind over here. Okay, there you go. Question number 5. If you calculate your BC, this is 5370. If it is amalgamation in nature of merger, your extra reference ke liye journal entries would be business purchase account debit to liquidator 5370, liquidator account debit to equity share capital to preference share capital, and then you will take over all assets, all liabilities, sundry assets, basically each and every asset, land and building, plant and machinery, furniture, investments, inventory, trade receivables, cash, sub jod jad ke. Can I say this is 6600 to liabilities? Acha, what will I take over the liabilities? Well, I will take over trade payables, other current liabilities, debentures, everything. So this is what? 700 and 150, maybe 850 worth of sundry liabilities. Okay, this is sundry liabilities worth 850. Now, in case of amalgamation in nature of merger, will you take over the reserves as well? Please tell me. Yes. In which case, as a special case, your reserves, general reserve, export profit reserve, investment allowance reserve, and P&L. All of these reserves will be taken over. As you can see, we have put this with a different color pen. All of these reserves will be taken over. And there will be a business purchase account that was earlier created, which is now no longer required, and hence to business purchase you will credit. And there is a balancing figure. Now, can I debit goodwill over here? No. I will debit the general reserve over here because this is amalgamation in the nature of merger. Yes, if it was in the nature of purchase, that you will do in part B. This balancing figure might go to goodwill, but at the same time, you will not take over reserves. Are we clear with this? So this will be in general reserve. So sir, what will be there in the final general reserve? X का तो general reserve होगा ही 500 plus 250 minus 670. So 500 plus 250 minus 670, can I say there will be only 80 remaining in the net general reserve at the end when you prepare the balance sheet. Now if you look at amalgamation in nature of merger, your balance sheet would be, well, land and building will be 4050, plant and machinery 3250 plus 1700 4950, Furniture will be 575 and 350, 925, 700, 500, 1200, 1250, 950, 2200, 900 and 1030. I think this is 1930 and 725 and 520, 1245. Even over here in general reserve is the only place where there is a challenge. This is 80. Export profit reserve is 500. Investment allowance reserve 100. Profit and loss account I will add 1250. Debentures, well, I will for the time being add 500 and 350. This is 850. Now if you look at the debentures of Y will be converted to equivalent debentures of X. So over here there will be 350 debentures of X, but they will be worth 350 only. And trade payables will be, I think, 800. Other current liabilities 350. Now when I look at purchase consideration, I will not take over the share capital. In fact, I will issue my own shares for 3500 and own preference shares worth 1870. So if I look at this is what, 8500 on the share equity share capital and 2200 and 1870, 4070 on the preference share capital, and that is about it. Now if you look at this balance sheet, you look at 4070 and 8500, we get 12,570, perfect. Then when I look at the reserves will be what, 80 of general reserve, 500, 100, 1250, 1930. You can see reserves of 1930, and then you will have debentures, trade payables, other current liabilities, all of this in the same way that we had discussed. Are we clear with this? So over here, one by one, you will add each of these items. Unlike consolidation where there is parent and subsidiary separate, you don't necessarily need to show all of that separately. For the other items, you can directly show it in brackets over here. 1245, 1930, 2200, like we have shown over here. 1930, 2200, and then investments come to 1200. Now there are multiple items in PP, so you will total up 925 and I think 4950 and 4050. This is 9925. 9925, and thereby you will total this up and find. Okay, now if I look at amalgamation in nature of purchase, again my PC will remain the same, 5370. However, when I take over net assets, business purchase account debit to liquidator 5370, liquidator account debit to equity share capital to preference share capital remains the same. But when I take over the net assets, I'll ideally take it over at fair values, but fair values are not given, so we'll have the same values. And when I take over the liabilities, will there be any reserves over here? No. So if I look at this, there will be no reserves over here which are taken over. Amalgamation nature of purchase. So this will be sundry assets 6600, sundry liabilities 850, to business purchase 5370. Balancing figure is capital reserve. If it came on the debit side, it would have been goodwill. Now I'll have to have a statutory reserve. In this case, there's an investment allowance reserve as well as export profit reserves, which I'll have to create. Debit will go to the amalgamation adjustment account. Now, once you do all of this, you will have the same assets and same liabilities, but in the equity share capital schedule, again, you'll have the equity shares, preference shares issued. The only difference will be in the reserves working. In the reserves, I will only have the reserves of X, which is 500, 300, 750. This is 500 plus 300 plus 750. वैसे 1550 वैसे you will also take over the export profit reserve of 200, investment allowance reserve of 100, but that will be negated by a minus amalgamation adjustment reserve. As you can see over here, you will have general reserve minus, this was adjustment for merger in the first case. In the second case, general reserve is 500 of X, P&L is 750, export profit reserve you will add, investment allowance reserve you will add, but then there will be an amalgamation adjustment reserve. And there was also a capital reserve of 380, and hence that comes to a total of 1930 over here, and everything else remains the same. So here this question does not have a lot of sting, to be honest. However, because it is one of those questions where they are testing you on both purchase as well as merger, it is a good starting point, especially the reserves and surplus note. For both of these is something that you should diligently refer to. Okay, next after question number 5, you will go to question number 9, mark that as important. We'll go to 18, 19 as well. चलो यहाँ पे है तो 18, 19 कर लेते हैं पहले. Let us go to question number 18, 19 and then you go to 9. 9 is an important question. 18, 19 फटाफट हो जाएगा. Now following is a summarized balance sheet of A Limited as on 31st March 15. You have the summarized balance sheet. R agreed to take over the business of A. Calculate the PC under the net assets method. Till now we have done PC as per the net payments method, but here you record BC based on the net assets method. On the basis of the following, market value of 75% of the sundry assets is estimated to be 12% more than the book value, and the remaining 25% and 8% less than the book value. The liabilities taken over are at book values only, but there is an unrecorded liability of 25,000. Still, you will have to consider that. So when I look at the net assets in this particular case, I will say sundry assets will be maybe 18 lakhs into 75% plus 12% and 18 lakhs into 25% minus 8%. So how much do you get? 18 lakhs into 75% plus 12% and 18 lakhs into 25% minus 8%. So this is 19 lakh 26,000. Sundry assets will be 19 lakh 26,000 minus there will be liabilities at the book values. All of these liabilities would be as it is 2 lakhs 240 and 50,000 comes to 4 lakh 90. And over and above that, there is also an unrecorded liability of 25,000. And hence, you will have what? Is it 14 lakh 11,000 by any chance? So, using the net assets method, what you are acquiring is net assets worth approximately 14 lakh 11, and that should be your purchase consideration. So, if you go to question number, I think 18, as you can see over here, perfect, 14 lakh 11,000 after considering all of these workings. Okay, next you go to question number 19. नहीं चल ठीक है, question number 19 we can do. Let us review question number 19. On 1st April 18, Tina agreed to take over the business of Reena and discharge the purchase consideration as follows. So this is BC. Issued 50,000 fully paid equity shares of rupees 10 each at a premium of rupees 15 to the equity shareholders of Reena. So this is 50,000 into, can I say 10 and 5, 15, that is equal to 7 lakh 50. This is clearly a part of PC. A cash payment of 50,000 was made to the equity shareholders. 50,000 cash payment, again a part of PC. Issued 2,000 12% preference shares of rupees 100 each at par to discharge the preference shareholders of Reena. 2,000 preference shares of rupees 100 each, again at par, and hence this is 2 lakh. Part of BC again. And debentures of Reena of 1 lakh 20 were converted to equal number and amount of 10% debentures of Tina. Now this is a part of net assets, not a part of BC. Calculate the amount of purchase consideration as per AS 14 and pass a journal entry relating to the discharge of purchase consideration in the books of Tina. So basically your purchase consideration would be 7 lakh 50 plus 50,000 plus 2 lakhs. Can I say this is a total of 10 lakhs? And if you had to pass the journal entry, your journal entry would be business purchase account debit to liquidator 10 lakhs and then liquidator account debit 10 lakhs to equity share capital 50,000 into 10, that is equal to 5 lakhs, to securities premium 2 lakh 50. So 5 lakhs and 2 lakh 50 comes to 7 lakh 50, to cash bank 50,000, to preference share capital 2 lakhs. Are we clear with this? So as you can see, it's an exam question, a bonus question we can say. Okay, next you will go to question number, I think we can now go to question number 9. It's a good question. It was selling company के लिए है. So 18, 19 is done. Now we'll go to 9. 9k lines by 17 hai. After 9 is done, you can try 17 on your own. Go to question number 9. It's an important question for your last day revision. Let us review this. The following are the summarized balance sheets of P and Q as on 31st March 11. Okay, so we have the summarized balance sheets of P and Q as given over here. And the details of trade receivables and trade payables are as under. So you have been given the details of trade receivables. This is a breakup of 4,20,000 and 2,10,000 as given in the question. 4,20,000. 2,10,000 made up of debtors as well as bills receivable and trade payables. Again, the breakup given between creditors and bills payable. Fixed assets of both the companies are to be revalued at 15% above their book values. Again, fixed assets of both the companies are to be revalued at 15% above their book values. Inventory in trade and debtors are taken over at 5% lesser than their book values. Both the companies are to pay 10% equity dividend, preference dividend having already been paid. Again, this is to be done by both companies. So this is a pre-acquisition adjustment that has to be done by both the companies. After the above transactions are given effect to, P Limited will absorb Q on the following terms. 8 equity shares of rupees 10 each will be issued by P at par against 6 equity shares of Q. 8 shares of 10 will be issued by P at par against 6 shares of Q. So this is a part of PC. How many shares are there in Q? I think equity shares of rupees 10 each. In Q there must be 30,000 shares. You have been told 8 equity shares against 6 shares. So this is into 8 by 6. 30,000 into 8 divided by 6. Can I say this is equal to 40,000? 10% preference shares of Q will be paid at a 10% discount by issue of 10% preference shares of rupees 100 each at par in P. So you will have 10% preference shares in Q will be paid at a 10% discount by issue of 10% preference shares of rupees 100 each at par. So can I say over here, I don't know what the issue price earlier was. So let us say, we can say this is into rupees 10 if nothing is given. So this is 40,000 into 10 can be 4 lakhs. And then when you look at preference shares, this is to be settled at a 10% discount. So 1 lakh minus 10% will come to 90,000. This is also a part of PC. 12% debentures of Q are to be paid at a 8% premium by 12% debentures in P issued at a discount of 10%. Now you cannot say this is a part of PC, this is a part of net assets. Okay. 30,000 to be paid by P to Q for liquidation expenses. And sundry creditors of Q include 10,000 due to P. So these are a few adjusting entries. There is an intercompany receivable payable. There are some liquidation expenses. There is a debenture adjustment. They are not a part of PC. First, they are asking you to prepare journal entries in the books of P and then statement of consideration payable by P. Can I say statement of consideration payable will be 4,90,000? If I look at question number, I believe 9, 19 तो चलो हमने कर दिया, 18, 19 done. If I look at question number 9, where is this? Yes. Can I say this is 4 lakhs and 90,000? So step 1 is calculating PC, 4 lakh 90. Now the question is not asking you to create any balance sheet or so, but they are asking you to pass journal entries in the books of P. P is the acquirer over here. So when you do journal entries, first is a business purchase entry. So there's a business purchase account debit 4 lakh 90 to liquidator 4 lakh 90. Yes sir, but before that there are 2 entries that we need to do in this case, because both companies have agreed to revalue their fixed assets and both companies are to pay a 10% dividend. So before you pass that entry, I will say both companies are to revalue fixed assets. Fixed assets of both companies have to be revalued at 15% above the book value. So over here, 2,50,000 into 15%. This is 37,500. Again, I say, irrespective of the acquisition, we have agreed to revaluation, and hence fixed assets account debit 37,500 to revaluation reserve. Pre-acquisition entries, fixed assets to revaluation reserve. अच्छा, sorry, किसके बुक्स में एंट्री पास करना है? We have to pass entries in the books of P. P के बुक्स में 7 lakhs के फिक्स एसेट्स है. 7 lakhs into 15%. 7 lakhs into 15% comes to 1,05,000. So this is 1,05,000. Second, even P will pay dividend. Q तो pay करेगा ही. P will also pay dividend. So when I look at P is going to pay dividend. Both the companies are to pay 10% equity dividend. Preference dividend is already paid. Inventory and debtors are to be taken over at 5% lesser. So P ka inventory you are not going to touch. Q's inventory and debtors you will take over at 5% lower. But P's inventory remains the same. And hence over here we will do a equity dividend of 6 lakhs into 10%, that is 60,000. Your entry will be profit and loss. Or what are the reserves? Reserves and surplus account debit to dividend payable, and then dividend payable account debit to bank. This will be at 60,000. Reserves account debit to dividend payable, and then dividend payable account debit to bank. These are your pre-acquisition entries in the books of P. Then P will do business purchase. Business purchase account debit to liquidator 4,90,000. Liquidator account debit to equity share capital 4 lakhs to preference share capital 90,000. You see, liquidator account debit to equity share capital 4 lakhs to preference share capital 90,000. Now comes a problem. Now I'll have to take over the net assets. Net assets of Q would now be worth, this is 2,50,000 plus 37,500, so this is 287,500. Aja. Then when you look at investments, maybe this is 80 only. Inventories will be less. Over here they are saying inventories and trade debtors are to be taken at 5% less than their book value, so this is minus 5%, and so is the case with trade receivables. So trade receivables means if debtors are to be taken over at 5% less, this is 1,90,000 minus 5%. Bills receivable will remain as it is. So I will have 287,500 for my fixed assets, 80,000 for my investments. But when I look at inventories, inventories would be 320 minus 5% will be 3,04,000. Aja, when I look at debtors I'll take over at 1,90,000, and if I want I can create a provision for bad debt separately at 5% of 9,500. Instead I've shown that separately, so we have done that. Alternatively, you can take over debtors directly at 1,90,000 minus 9,500, that is 1,80,500. That is absolutely fine. Next, bills receivable will be taken over as it is, that is 20,000, and then comes cash. Now cash, you will say कि कोई adjustment ही नहीं है, गलत है, there is an adjustment. Remember, both companies have to pay dividend, and hence यहाँ पे भी 3 lakh into 10%, 30,000 would have been paid as dividend, and hence only 10,000 worth of cash would be remaining. So over here you can say 10,000 worth of cash. 2. When you look at liabilities, there is a 12% debenture. Now this is a very dangerous adjustment. What do they say? 12% debentures of Q are to be paid at a 8% premium. So if they had to be paid in cash, we would have paid 1,50,000 plus 8%. Can I say 1,62,000? Now how are they paid? By issuing 12% debentures in P at a discount of 10%. We'll see that. But what we have agreed to pay is, if you have to pay me, you have to pay 1,50,000 plus 8%, that is 1,62,000. And hence this is 1,62,000. 12% debentures. Next, you will have well, creditors taken over at 125, bills payable taken over at 25, and hence 1,50,000. So this is creditors taken over at 25 and bills payable as well. Then you have business purchase, and the balancing figure, if any, will go to the capital reserve. So over here you'll have to look at this entry. In my understanding, this is a fairly interesting entry, and you have to try to do this properly. So this will give you your capital reserve. Now after that, there are some entries on account of adjustments like intercompany receivables payables. So there is a last line, 10,000 intercompany receivables payables. Your entry will be trade payables or creditors account debit 10,000 to debtors 10,000. Second, 30,000 is to be paid. This will be capital reserve account debit to bank 10,000, 30,000, and then the debenture entry. So if you go to see over here, capital reserve account debit 30,000, creditors account debit to debtors 10,000, and then the dangerous debenture entry. So when you look at the debenture entry, what is given? they say 12% debentures of Q. Well, you have taken them over at the agreed amount, that is 162, are to be paid by issuing 12% debentures at a discount of 10%. So the issue price is 90 for these new debentures. However, the face value must be 100 and there would be a 10 discount. Ultimately, the issue price is 90 and that will equal to 1,62,000. That means 100 is how much? 10 is how much? So your entry will be over here. This is 1,80,000, which is a total face value. 18,000, which is a total discount. So your journal entry will be, if you go to see, your journal entry will be old debentures account debit 162, two new debentures 1,80,000 and 18,000 will be discount on issue of debentures. So over here, this will be old debentures of 12% of Q account debit. You will remove that 162. In lieu, you are issuing new debentures of 1,80,000 at a discount of 10%. And that will be your effective entry. So this is a fairly interesting question. What I would want you to do is separately pause and try question number 17 on your own. This is similar to question 9 in all aspects. We'll quickly discuss this as well, but you can pause and try 17 first on your own. Following are the summarized balance sheet of VT and MG as on 31st March 18. The entire balance sheet, same debtors, receivables, fixed assets of both the companies are to be revalued at 15% above the book values. Inventory and debtors are 5% lesser. Both companies are to pay 10% equity dividend. Preference dividend already been paid. And after the above transactions are given effect to, VT will absorb MG on the following terms. VT to issue 16 shares of rupees 10 each against 12 shares of MG. So this will be a part of PC. So this is 16 shares against 12 shares of MG. MG would have probably 60,000 shares into 16 divided by 12, जो भी number आता है, into rupees 10. So this is 60,000 divided by 12 into 16 into 10, maybe 8 lakhs. This is a part of PC. 10% preference shares to be paid at 10% discount. So whatever are the preference shares, 2 lakhs at a 10% discount, maybe. This is 1,80,000. And 12% debentures are to be paid at a 8% premium by 12% debentures in VT issued at a discount, exactly the same adjustment. So over here, when you go to see, you will say that ideally these debentures of 3 lakh are actually worth 3 lakh plus 8%. This is 324. However, 324 is equivalent to 90, then 100 is how much? 3,60,000 will be the total face value. Maybe around 36,000 will be the discount and 324 will be the settlement value. And 67 is to be paid by VT to MG for liquidation expenses, capital reserve or goodwill account debit to bank. Sundry debtors of MG include 10,000. What they have done is conveniently done everything into 2, I think. Sundry debtors of 20,000. Intercompany elimination. And you are required to pass the journal entries and prepare a statement of consideration. Are we clear with this? Now, there's nothing new over here, but this was in the main exams. Now, if I go to see what the institute has done, is an alternative solution is very much possible. When you create a provision for bad debts, one can always argue and say, why am I creating a provision of the entire 1,90,000 into 5%? Can I say out of that 1,90,000, maybe 10,000 is intercompany? So I can also create a provision of 1,80,000 that is also permissible. Though if you see your study material of even May 25, institute has created a provision of the entire 1,90,000 and hence we will continue doing so. Okay, so this takes care of these questions. Next, you can go to the question number 21, 22, 23. Now, each of these questions I would say are good questions, and these are either in the RTPs or in the main exams. You can 21, 22, 23. All the 3 questions are important from a last day revision perspective. So let us get started with them. So just a second, we'll go to question number 21. These are all last day revision questions. I had to change my iPad. Just a second. So these are all LDR questions as we have discussed. This is LDR, LDR and LDR. Let's go to question number 21. There is Galaxy and Glory are 2 companies engaged in the same business of chemicals. To mitigate competition, a new company, Glorious, was formed, to which the assets and liabilities of the existing companies with certain exceptions are to be transferred. The summarized balance sheet of Galaxy and Glory as on 31st March 2020 are presented. So you have the entire balance sheet. Over here, I think this is 5,88,000 freehold property. And assets and liabilities are to be taken over at book value with the following exceptions. Debentures of glory are to be discharged by issue of 8% debentures of glorious at a premium of 10%. Now there are two interpretations over here which is possible. One is that the debentures of glory are to be discharged by issue of debentures of glorious at a premium of 10%. So we can say that these are the debentures which are worth 3,30,000 and they are discharged by debentures of glorious at an issue price of 110, or you can say 330 plus I think premium of 10%, 3,63,000, and that is discharged by the debentures at par value. So this is one ambiguity over here which is there. I'll tell you what I believe should be the answer and what institute has done. Plant and machinery of Galaxy are to be valued at 2,52,000. This is for Galaxy only. Plant and machinery which is worth 2,52,000. Next, goodwill is to be valued for Galaxy at 448. Glory at 168. Goodwill is given to you. Generally, goodwill is not given, but in this case, goodwill is given to us. And the liquidator of glory is appointed for collection. Liquidator of glory, okay, is appointed for collection from trade debtors and payment to trade creditors. So this money will be collected. He retained the cash balance and collected 1,10,000 from the debtors and paid 1,80,000 to the trade creditors. The liquidator is entitled to receive 5% commission on collection and 2.5% on the payments. The balance cash will be taken over by the new company. Now we can say that over here, trade receivables of glory will be collected. Instead of this, 1,10,000 of trade receivables will be collected, and trade payables over here will be paid. Instead of 1,83,000, I believe 1,80,000 will be paid. However, there is some commission as well. So what will be the commission amount? Well, this will be 2.5% on payment. So this is 2.5% of 1,80,000 and 5% of 1,10,000. So this is what? 1,80,000 into 2.5% and 1,10,000 into 5%. Total comes to I think 10,000, is it? And this 10,000 you will further deduct, and they have said the net amount will be taken over. So basically 1,04,000 plus another 1,10,000 minus 1,80,000 minus 10,000. Can I say all said and done, I will be left with around 24,000 of cash which can be taken over. You are required to compute the number of shares to be issued to the shareholders of Galaxy and Glory, assuming that the nominal value of each share of Glorious is 10. So maybe the PC over here has to be calculated using the net assets method, because we don't have any exchange ratio or any of that. So PC will be as per net assets, and then prepare the balance sheet of Glorious as on 1st April 2020, and also prepare the notes to accounts as per Schedule 3 to the Companies Act. So first is a PC calculation. Now if I look at Galaxy, within Galaxy I will have 5,88,000 plus 252,000 plus 56,000 plus there will also be some goodwill worth 4,48,000. 448,000 plus 336 plus 462 plus 238 minus liabilities of 4,20,000, and that's about it. I think 19,60,000 if I'm not wrong. And this is 19,60,000 divided by 10. So this is 1,96,000 shares to be issued. If I were to go to see over here, just a second, if we go to question number 21. So if you go to see all said and done, net assets equals to the purchase consideration is 19,60,000 divided by 10, that is 1,96,000. Perfect. Now, when you go to the more complicated version, that is Glory, Galaxy was relatively easier. When you look at Glory, I will again take over all the assets. 336 plus 84 plus there will be a goodwill of 168 plus Well, inventory is worth 438. Trade receivables are fully collected, so you don't have to take over separately. And then a net cash balance of 24,000. 10 lakh 50 minus, you will have a secured loan over here of 3 lakh 30 and trade payables have been paid off. So 3 lakh 30. Now the way this language is worded, in my opinion, this is correct, is that debentures of glory are to be discharged. Okay. So 3 lakh 30 worth of debentures are to be discharged by the issue of debentures of glorious at a premium of 10%. Had they told you that debentures of glory are to be discharged at a 10% premium, then I would have said yes, 3 lakh 30 plus 10% हमें करना चाहिए. However, they have not told you that the debentures of glory are to be discharged at a 10% premium. No, they have just said debentures of glory are to be discharged, which means 3 lakh 30 ka debentures to be discharged at 3 lakh 30. Just that you will issue the 8% debentures of glorious at a premium of 10%. So maybe the issue price of this new debentures is 110. So if 3 lakh 30 is equivalent to 110, then 100 is how much? So that is 310 is the securities premium. So over here, I will still take, I think, 3 lakh 30,000 only. So this is 336 plus 84 plus 438 plus 24, all said and done, minus 3 lakh 30 plus 1 lakh 68 for goodwill. So this is, I think, 7 lakh 20,000. If we just verify this over here, can you see 7 lakh 20,000? Perfect. Divided by 10, and that's about it. If you are able to crack this, your question is kind of done. Then you just have to total both of these and that will be your balance sheet. So over here, the important adjustments, as you can see over here, would be that trade receivables will be nil because they have been collected. Trade payables will also be nil because they have been paid. But cash balance will be 24,000. As we have seen this note over here, cash balance will be 24,000, and the 6% debentures at note 1 we have mentioned would be at 3 lakh 30. The adjusting entry for that would be 6% debentures of 3 lakh 30 to new debentures of 3 lakhs and then securities premium of that to be 30,000. Are we clear with this? Now when you look at the balance sheet of Glorious, it is just a total 588 plus 336, that is property 924. Then you have 252 and 84. 336 for plant and 56,000 for motor vehicle. So this is 13 lakh 16,000. 13 lakh 16,000. Then goodwill would be the total of 448 and 168. So goodwill will be 6 lakh 16,000. Okay, next you will have inventories. Inventories will be the total of both 336 and 438, that is 774. And then you will have trade receivables. This is only 462. Cash will be 238 plus 24 will be 262. 462 and 262. And then in your share capital, we will have 1,96,000 plus, I think, what was that? 72,000 into 10 comes to 26 lakh 80. This is 26 lakh 80. Now, because this is an amalgamation and it is not in the nature of merger, it is not told, so we'll assume it is in the nature of purchase, and hence you will take over the share capital and also the reserves. The reserves will be taken over. No. However, there's a security premium of 30,000 that will come on the issue of debentures, and new debentures will be worth 3 lakhs only. This is your adjusting entry. New debentures worth 3 lakhs at a premium of 30,000 in lieu of old debentures worth 3 lakh 30,000. And then your payables would only be the payables over here of 4 lakh 20,000, and that's about it. And that's it. That is your balance sheet regarding this question. Are we fully clear regarding question number 21? Okay, next you'll have question number 22. Now the summarized balance sheets of Black and White as on 31st March 2020 is as follows. You have been given the summarized balance sheets of Black and White, and Black Limited takes over White on 1st July 2020. Now this is not on the same date of the balance sheet. The balance sheet is on 31st March 2020, so there is a 3-month time gap. Now no balance sheet of White is available as on that date. It is however estimated that White will earn a profit of 2 lakh 40 after charging proportionate depreciation at the rate of 10% on PP during April to June. So 2 lakh 40 से आपका reserves बढ़ेगा. The estimated profit of Black during these 3 months was 4 lakh 80, again after charging proportionate depreciation at the rate of 10% on PP. Both the companies have declared and paid 10% dividend within the 3-month period. Okay, this will help you in calculating the cash balance which might be there. Now the goodwill of White is valued at 2 lakh 40 and the PP are valued at 1 lakh 20 above the depreciated book value on the date of takeover. So this is a very unique question where you have been asked to do adjustments for those 3 months. Purchase consideration should be satisfied by Black Limited by issuing shares at par. Okay. Ignore tax and you are required to compute the number of shares to be issued by Black to White against the purchase consideration. Now PC over here will be calculated how? Well, PC they have just mentioned is to be satisfied by Black by issuing shares at par, but how many shares? Have they told you that? No. So how many shares will be issued? Well, that depends on the net assets. So I'll have to find the net assets of White, but net assets of White as on which date? This will be based on the net assets of White as on the date of acquisition, that is on 1st of July 2020. Now, why will the net assets of White change? Well, to start with, it will change because of profit. So profit के वजह से definitely your reserves of White will increase, maybe by 240. However, this is a profit after depreciation. Depreciation will be 10% of PP. Now PP over here would be 2400 into 10% into 3 by 12. Can I say 60 would be your depreciation? Are yes or no? And hence this will come to, let us say, 2340. 2340. Perfect. This will be there in the balance sheet. However, if I look at the cash balance, can I say that if 2400 and 60 was the depreciation, my cash would have gone up by, if you prepare the cash flow statement, your cash will be 240 plus the depreciation, that is maybe 300. Okay. Again, both companies have paid 10% dividend during the 3-month period. So if I have to look at the cash balance, I will say that my cash balance at the starting was 420. This would have gone up probably by 300. But again, there was some dividend. So 360 would have been the dividend paid. And then 420 plus 300 minus 360. Can I say this would be 360? Will be my remaining cash balance. Perfect. Now, unless given otherwise, we will take everything else remains the same. So over here, we will, if I have to calculate the net assets taken over, this will be 2340. But यहाँ पे आपको बोल के रखा है that the PP is worth 120 more. And hence, when you take this over, goodwill of White is 240, PP is worth 120 more. So if I want to find the net assets of White, the net assets of White will be PP of 2340 plus 120. This will be 2340 plus 120 comes to, I think, 2460. There would be a further goodwill. Goodwill amounting to 240. Other than that, there will be inventories worth 720. There will be trade receivables worth 1080. And there will be cash balance which is worth 360. So if I total all of this, I will get the total assets minus the liabilities. I think the liabilities are trade payables worth 360. Unless given otherwise, this will remain the same. And hence 2460 plus 240 plus 720 plus 1080 plus 360 minus 360. I believe this is 4500 and this will be discharged by issuing shares at the rate rupees 10 each at par. And hence, maybe these are shares of rupees 10 each, right? And hence this will be 450 shares of rupees 10 each. So if I were to verify this, let us say for Black, I'll find the net assets of White on 1st July. 2460 will be my PP. Cash bank, as we said, was 360 after all of those adjustments, and 4500 divided by issue price, let's say is 100. Then this will be 45 shares of rupees 100 each. Okay. Next, what are they asking you? If you have done point 1, the other points will flow through very easily. Calculate the balance of net current assets of Black and White as on 1st July. So for White, it is very easy. For White, your net current assets will be 720 plus 1080 plus 360 minus 360. 720 plus 1080. For White, I believe this is 1800. I've done all the calculations. For Black, I will do a similar calculation. Now, White had earned a profit of 240. But Black had earned a profit of 480. Again, after 10% depreciation, now what must be the depreciation? Over here, this is 3600 into, I think, 90. So this would be minus 90, and 3600 minus 90 would have come to 3510. Okay, just for our reference. Further, there was a 480 profit after depreciation, but 480 plus 90 would be 570 cash flow. Your cash will increase by 570 and 10% dividend, so minus 600. 1440 plus 570 minus 600. So can I say this is 1410? All else remaining constant. So over here your net current assets would be 960 plus 1680 plus 1410 minus 600. This is 3450. This is 3450. So when you do this working, you will have, let's say, for black 3450, for white 1800. Perfect. Next, you will have, give the balance of the P&L of black as on 1st July. Well, P&L of black will be 1080 plus 480, and that's it, 1560. Okay, and the PP balance as on 1st July after the takeover, PP will be 3510 for black, plus I will take over PP worth 2460. 3510 plus 2460, and this will be 5970. So if you go to see over here, this will be part C, profit and loss will be, oh, I missed out the dividend. So profit and loss of black would have been, I think, 1080 minus 600 because of the dividend being paid, and then 480. Maybe this will come down to 960. As you can see, I missed out one important point. This is 720. Maybe ये तो मैंने total reserves लेके रखा हुआ है. I think in reserves and surplus note there is general reserve and there is profit and loss. Profit and loss is 720. 720 के ऊपर there will be a 480 profit and minus a 600. This is 720 plus 480 minus 600 will come to, finally, hopefully this is correct, finally, 600. And then when you look at PP, this is 5970. Are we clear with this? Yes, so this is question number 22. The only question where you have, so this is I think 600 and this is 5970, where you have that 3-month gap where you have to do some adjustments. Next you go to question number 23. The balance sheet of truth and myth as on 31st March 2021 is given below. Myth is due to be amalgamated with truth. So truth is the acquirer, myth is the target. As on 1st of April 2021, the amalgamation is to be carried out in the nature of purchase. They have told you, but even if they had not told you, we would have taken in the nature of purchase only. So this is the entire balance sheet of truth and myth. And the notes. Truth would also issue 12% debentures to discharge the claim of the debenture holders of myth, so as to maintain their present annual interest income. So when I look at the myth, debentures, non-current liability is 1,50,000, and this 1,50,000 is 14% debentures of 1,50,000. So their current interest is 1,50,000 into 14% comes to 21,000. Now I will issue debentures of 12% in such a way to maintain their present interest. So if 21,000 was to be earned using a 12% interest, your debentures will be what? Sir, I will issue 1,75,000 worth of debentures, ताकि at 12% that will give you them still the same 21,000 of dividend. Non-trade investments, which constitute 80% of the respective total investments, yielded 20% to truth and 15% to myth. These are non-trade investments. This income is to be deducted from the profits while computing average profit for the purpose of calculating goodwill. Aja, now I have to calculate goodwill in this case. So there is some non-trade investments which are how much? If you look at your investments, 187,500 into 80%. Into 80%, I think both of them, the non-trade investment will constitute 80% of the total investment, yielded 20% to truth and 15% to myth. So over here 187,500 into 80% into 20%. I think 187,500 into 80% into 20% comes to, I think, 30,000 of income, and 1 lakh into 80%, that is 80,000 into 15%, 12,000 of income. This I will have to deduct. The profit before tax for both of these companies during the last 3 years was as follows. So this is a profit for the last 3 years. Goodwill is to be calculated based on the simple average of the 3 years profit by using capitalization method, taking 18% as the normal rate of return. Now, if I look at the average profit, this is 820 plus 745 plus 604. Divide this by 3. This is 723 minus 30,000. So can I say this is 6,93,000? And for mid 255 plus 215 plus 214 divided by 3, that is 228 minus 15 minus 12,000 comes to what? I think 2,16,000. And if I have to calculate goodwill by capitalization method, I will capitalize at the rate of 18%, 0.18, and the goodwill comes to what? 12 lakhs and 693 upon 0.18, and it comes to what? 38 lakh 50. We will just verify this, and if this is done, half of the question is kind of taken care of. Purchase consideration is to be discharged by truth on the basis of intrinsic value per share. Now, intrinsic value is based on the fair value of assets and liabilities. Prepare the balance sheet of truth after the amalgamation. Now, for that, well, I will have to look at the net assets. I think the net assets over here are the same. 6,80,000, there's no change. Investments, let there be non-trade investments, so what? And current assets. But there is also a goodwill. I believe there is a goodwill of around 12 lakhs over here. And minus the liabilities over here will be 175. So if I go to the net assets, I'll have to do it for both companies because I have to find the exchange ratio. I'll have to take intrinsic value of both the companies. So if I look at the intrinsic value, for example, for I think, where is this question number? 23. Yes, for goodwill calculation, I will take 723 minus 30 comes to 693 divided by 0.18, 38 lakh 50. 228 average minus 12,000, 2 lakh 16 divided by 18, this is 12 lakhs. Okay, now if I want to find intrinsic value, I will take the fair value of all assets and liabilities, including goodwill. So over here, you will look at total assets less non-trade investments and liabilities. This will give you capitalized value. Oh, I'm sorry. I've just capitalized over here directly the profits. That is not how you will do the working. You will find this is a capitalized value of the adjusted net profit. Goodwill अपन कैसे करते हैं? Like this is more of a goodwill question. Like you remember, you do super profit minus normal profit. Here you don't have data regarding normal profit, super profit separately, but you are saying that based on your actual profit, your total value of your entire company, operating company, should be worth 38 lakh 50 or worth 12 lakhs as a case. Maybe this is for your entire profits. Ideally, if you could have found a normal rate of return, actual profit, found super profit, it is different. But here, what you will do is you will try to find your total assets as per the balance sheet, minus the non-trade investments because they are non-operating, less the total liabilities as appearing in the balance sheet. So this will give you your operating assets. Now ideally, if my operating assets is 19 lakh 85 and the total capitalized value is 38 lakh 50, the difference over here of the capitalized value and the net operating assets will be the goodwill. This so goodwill is 1865 and 467. It's a slightly different method of calculating goodwill. You are not finding goodwill directly. You are saying that whatever is the profit, capitalized at 18%, I'll give you the capitalized value of the entire business, like the market cap. However, as per your net operating assets, they're coming to 1985 and 733, and hence if your market cap is around 38 lakh 50, whereas 1985 are your operating assets, the remaining 1865 is attributable towards goodwill, or 467 as a case may be is attributable towards goodwill. Now when you calculate PC ke andar you will take the total assets, plus you will also add the goodwill, plus you will also add the non-trade investments. This is total assets as per balance sheet, so this includes the non-trade investments as well, plus the goodwill, and then minus the liabilities of 1,75,000 as we calculated, and hence this will come to 40 lakhs and 12,55,000. Divide this by the number of shares. This will give you 40 ka intrinsic value. This will give you 31.375 ka intrinsic value. Your ratio will always be target upon acquire. So this is 31.375 divided by 40. So if I calculate the PC, this is 40,000. shares के लिए 31.375 and hence this is 12,55 divided by 40 rupees and this will give you 31,375 shares. Now once you do that, after that you are just going to total everything. So this is जो हमारे existing shares है plus 31,375, 1 lakh plus 31,375 of rupees 10 each. Now these are shares which are going to be issued at a premium and hence there will be a securities premium. This is 31,375 shares which are issued at the rate, well, let's say 40 minus 10, that is equal to 30. So this is 31,375 into 30 comes to 941,250. Apart from that, you will have 12% debentures, 175. Everything else you will just add as it is. Goodwill, you will only have the goodwill of myth. You cannot take over the goodwill of truth in the books of truth. So goodwill will be myth's goodwill of 4,67,000. PP you will total, investments you will total, inventories you will total, everything else is the same. It is just that when you are acquiring, you can only take over the goodwill of the selling company, not goodwill of the purchasing company. Are we clear with this? Yes. Okay. So this takes care. There are some export profit reserves. So there's a statutory reserve adjustment and P&L of truth, general reserve of truth will continue. So that kind of takes care of question 23 as well. 21, 22, 23 is something where you will need a bit of practice. Okay. So we will stop for now and we will continue with the remaining in the next session for amalgamation. Okay. So do practice whatever has been done and we'll continue in the next section for this, for completing amalgamation. Okay, so we'll continue with amalgamation. We discussed up to question number 23 in the classwork section and now we'll pick up a few of the homework questions and then also go to the remaining sums of the classwork. So we'll go to question number 14 first on your homework section, which is similar to question number 4, that Neil and Gagan type of a question with a few changes. Let us quickly review this. Now X and Y have been carrying on business independently and they agreed to amalgamate and form a new company XY with an authorized capital of 40 lakhs divided into 8 lakh equity shares of rupees 5 each. On 31st March 2023, the respective information of X and Y was as follows. So you have the information given for X and Y, everything given, additional information, and the following revalued numbers of non-current assets and current assets are given for PP as well as current assets. The debtors and creditors included 137,250 owed by X to Y. This is intercompany. However, when you calculate the net assets, you will take all the net assets including even the intercompany items. The purchase consideration is satisfied by issue of following shares and debentures: 620,000 equity shares of XY to X and Y in proportion to their profitability of their respective business based on the average profit during the last 4 years. So based on that, you will try to find the profit divided by 4, that will give you the average profit, and then 7.5% debentures in XY at par to provide an income equivalent to 4% return based on capital employed in their respective businesses as on 31st March 23 after considering revaluation. So if I look at your average profits, this is what 4250, 44, 45, 760 minus 75,000 including the loss plus 37, 79, 240. Divided by 4 comes to around, I think, 31 lakhs. And this is what, 26 lakh 50, 27 lakh 60, 34 and 35 lakh 90. Divided by 4. Is it around, just a second, 26 lakh 50, 27 lakh 60, 34 and 35 90. Divided by 4. Is it also 31 lakhs? So can I say it seems to be equal, maybe 3 lakh 10 and 3 lakh 10,000. You are required to compute the number of debentures and shares to be issued to X and Y and the balance sheet of XY showing the position immediately after the amalgamation. So we can say shares would be, I think, 3 lakh 10,000 or let's say 3 lakh 10,000 and 3 lakh 10,000. Can I say equal number of shares to be allotted of rupees 5 each? And when it comes to debentures, you'll say your return, which is what, 71 lakhs plus 29, 71 plus 29, 95 minus 59, 70. This is 4125, 4125 into, what is the rate? This is a rate of, I think, 4%. So this is 1,65,000 divided by 0.075. And hence this is 22 lakhs. Can I say this is debentures worth 22 lakhs? And over here, this is what, 39 lakhs plus 15 lakh 77,500 minus, I think, 18 lakh 2,500. This is around 3675 into 4% divided by, I think, 0.075 comes to around 19.6. And if we review that once over here in question number 14 of the homework section, you will have 22 lakhs of debenture and then 19 lakh 60, perfect. And then when I look at equity shares, 3 lakh 10 and 3 lakh 10 of rupees 55 each. And that is about it. That is your PC. Next, if you had to prepare the balance sheet, you will take over all assets and liabilities. So here we have done all this working to come to 22 and 1960. When you have to prepare, you will take the PC 3750 and 3510 as you calculated over here, compare it with the net assets. Your net assets will be, I believe, 41 lakh 25 and 3675. So your total will be 5 lakh 40,000 capital reserve, and there will be some intercompany trade payables and receivables which you will eliminate, and based on that you will prepare your entire balance sheet. So total share capital is, I think, 6 lakh 20 into 5, that is 6 lakh 20 total into rupees 5. Then you look at debentures, I think 22 lakhs and 19 lakh 60, that is 41 lakh 60. In terms of reserves, we as such don't take over any reserves. However, there would be, in this particular case, there are a few items that you might see in terms of your other equity. Let's say you look at reserves and surplus, this will be a capital reserve of 5 lakh 40 that will come. So usually there are 4 or 5 items. If it is an absorption, you will take over the reserves of the purchasing company. If there is a share issue at a premium, then there can be securities premium as a part of BC. If there is a capital reserve, that can be taken, and if there are any statutory reserves, that is something that you should be taking. Now in trade payables, you will subtract. Even in current assets, you will subtract, and other than that, it is just a direct addition. So this is question number 14. Next, if you go to question number 15 from the homework section again. So this is again a few exam questions, recent exam questions that we would want to discuss. So you have this entire balance sheet given, and then it is said that B is to declare and pay 1 rupees per equity share as dividend before the following amalgamation takes place with Z. So it is Z acquiring B. Over here, अच्छा Z and B क्या है यहाँ पे? Let's say this is A and B. Let's say A के बदले we call this as, नहीं, this is A and B only. Z is a new company maybe. So B is to declare 1 rupee equity dividend before the amalgamation takes place. If you look at B, that is 22 lakh 40,000 shares of rupees 1 each, and hence there will be a 2 lakh 40 dividend paid, and your reserves will also reduce by, I think, 2 lakh 40. Okay. Next, Z was incorporated to take over the business of both A and B. Z is going to take over both business. The authorized capital is 60 lakh divided into 6 lakh shares of 10, that is fine. As per the registered valuer, the value of equity shares of A is rupees 18 and that of B is rupees 12 per share, and agreed by the respective shareholders of both the companies. What does this mean? This means that the payment that you are going to make is based on 18 rupees per share of A. So total consideration will be, can I say 3 lakh shares into rupees 18? 3 lakhs into 18, that comes to around 54 lakhs for A, and around 2 lakh 40 into 12. 2 lakh 40 into 12, that comes to around 28 lakh 80,000 for B. So this is a slightly new adjustment. 10% debentures of A are to be issued 12% debentures of Z in consideration for their holdings. So it is the same amount. And a contingent liability of A of 2 lakhs is to be treated as an actual liability. So over here, along with the net assets taken over, there will be a liability of 2 lakhs as well that you will take. It's like an unrecorded liability. But if it is there at fair value, we should take this. Liquidation expenses, including registered valuer's fees of 50,000 for A and 30,000 for B, are to be borne by Z. So this will be adjusted against the goodwill or capital reserve that will be arise at the stage of acquisition. And the shareholders of A and B are to be paid by issuing sufficient number of fully paid equity shares of rupees 10 each at a premium of rupees 10 per share. So the issue price will be 20. So over here, your total PC, if you go to see, will be, I think 28 lakh 80 divided by 20. So there is 1,44,000 shares to be at the rate of rupees 20. And over here 3 lakhs into 18. This is 54 lakhs divided by 20. That is I think 2,70,000 shares of rupees 20 each. Assuming amalgamation in nature of purchase, you are required to pass the necessary journal entries. Narrations are not required. In the books of Z, Z will take over both and prepare the balance sheet of Z immediately after the amalgamation of both the companies. Step number 1, you will always calculate the PC. As we said, PC over here would be based on 54 lakhs and 28 lakh 80 divided by 20, that is 2 lakh 70 and 1 lakh 44,000. So that is 27 lakhs going into the share capital and 27 lakhs in the securities premium, and then 14 lakh 40 in the share capital, 14 lakh 40 in the securities premium. Now when you pass the journal entry, you will first pass the journal entry for A and B. Let's say you combine business purchase of A account debit 54 lakhs to business purchase of B. Then you will pay liquidator of A to share capital to securities premium, and then you will take over assets and liabilities. You will take over all assets and liabilities. There seem to be at book value and fair value is the same, but there's a contingent liability of 2 lakhs which you will separately add. So over here there is a other liabilities of 2 lakhs which will be separately added, and there would be, let us say, a balancing figure which will be going against combined goodwill or combined capital reserve. Further cash, as we said, would have been 3 plus 3 minus 2.4. If you go to see over here, we have mentioned that less 2.4 karna, so this is going to be 3,60,000. Now there were a few different items over here which I want you to know. First is a retirement gratuity fund. Basically it is a gratuity fund. It is paid to the employee as a liability, and hence this is like a liability. Unsecured loans, including loan from A, you will first take it over and then eliminate. So with your retirement gratuity fund is a liability. Then intercompany loans have to be eliminated to the extent of 2,20,000. What is intercompany? Then the expenses of 50 and 30, that is equal to 80, will be adjusted against goodwill. Goodwill account debit to bank by 80,000, and debentures were issued and old debentures were cancelled. Based on that, you will just total up the entire balance sheet. Are we clear with this? Question number 15. Nothing significantly different, just that this registered value or adjustment you should be kind of clearly aware of. Next you go to question number 16. Following is a balance sheet of A as on 31st March 11. You have been given the entire balance sheet of A, and then B has agreed to take over the assets and liabilities on the following terms and conditions. So discharge 15% debentures at a premium of 10% by issuing 15% debentures of X. So over here, if I look at the debentures of 700, maybe they're discharged at a 10% premium plus 10%, maybe 770. PP at 10% above the book values and investment at par value. PP at 10% above the book values and investment at par value. So this is 3250 plus 10% comes to 3575. Non-current investments will be at par value, that is 600 only. Current assets at a discount of 10% and current liabilities at book value. Current assets, whatever they are, at a discount of 10% and current liabilities at book values. Preference shareholders are discharged at a premium of 10% by issuing 15% preference shares of rupees 100 each. So if I look at preference shareholders, which is a part of PC, payment to preference shareholders 7,500 preference shares, 750. Discharge at a premium of 10%, 750 plus 10%, which probably comes to 825. Part of PC. Now issue 3 equity shares of rupees 10 each for every 2 equity shares in B, and pay the balance in cash. Now how will the balance come? Well, if I am issuing 3 equity shares of rupees 10 each for 2 equity shares in B, this is 3 by 2 into how many equity shares are there? 1,50,000 equity shares. Everything is in 1000, that is 150, and these are of rupees 10 each. So this will be 150 divided by 2 into 3, and this is into 10. This is 2250. So this is 2250. This is BC, and around 825 will be BC. And pay the balance in cash. Calculate the purchase consideration. So over here, if I want to find the balance, I will say 3250 plus 10%, 3575 plus 600 plus current assets, maybe if there's no other adjustment, this is 180, this is also 180. Here they have told current assets are at a discount of 10%. I'm not very sure whether cash should go at a discount of 10%, but otherwise current assets for sure will be at a discount of 10%. So this is inventories. if I go to see question number 16 over here, preference shares are clearly 825, equity shares are clearly 2250, but we have to find the balancing figure. So PP investment current assets including cash over here, institute has even taken cash, we will also take that. Current liabilities will be at book value, so this is 500 at book values, and long term borrowings will be, I think, at a 10% premium they are getting discharged, so this will be, I think, 770. So if I go to see my total 3575 plus 600 plus 180 plus 180 plus 80 minus 500 minus 770 comes to around 3345. This belongs to equity and preference both. Minus from this, I would say 825 goes to the preference, and hence 2520 remains for equity, out of which 2250 is towards equity, and hence the balance, I believe, 270 rupees or 280 rupees will be going out in cash. So over here 3355, all said and done, 3355, and after discharging whatever was agreed, the balance would be paid in cash. Here the challenge would have been to figure out whether you know whether net assets method was to be applicable or not. It is to be applicable because the balance amount is to be paid in cash. So how will you find the balance amount? You will first have to find the total amount. From that, subtract what is actually agreed to be paid to the preference and equity shares, and balance amount will be paid in cash. Okay, now before you go to question number 17, which is on the selling company, we will first discuss question number 13, I believe. Another question from the homework section. So there is a question number 13. There is a balance sheet of Akash and Ganga, and there is this entire balance sheet with fairly big numbers over here being given. Next, you have been told both companies go for liquidation, and a new company, Akash Ganga Limited, is formed to take over their businesses. So there is an amalgamation, and the following information is given. All current assets of the two companies except pledged inventory are taken over by Akash Ganga. Except for pledged inventories, the realizable value of all the current assets, including the pledged inventory, is 80% of the book value in case of Akash and 70% in case of Ganga. Okay, so this will help you in finding the assets. It's a slightly different adjustment. What is asked at the end? You are required to prepare the opening balance sheet of Akash Ganga as at 1st April 21. So this will help you finding the current assets. Okay, property, plant and equipment of both companies are taken over at book values. That's fine. Secured loans are at 32 lakhs and accrued interest, include accrued interest of Akash Ganga. 4 lakh equity shares of rupees 10 each are allotted by Akash Ganga at par against cash for the entire face value to the shareholders of Akash Ganga, Akash Limited and Ganga Limited in the ratio of shares held by them in Akash and Ganga. So basically, this is not BC. This is 4 lakh issued for cash. Your enter will be bank account debit to share capital, maybe 40 lakh rupees. Preference shares in Akash are to be issued equity shares in Akash Ganga worth 4 lakhs. This is part of BC. Secured loan holders agree to continue the balance amount of their loans to Akash Ganga after adjusting the realizable value of the pledged asset in case of Akash and after waiving 50% of interest due in case of Ganga. All of this are adjustments to net assets. Unsecured loans are taken over at 25% of the loan amount, and employees are issued fully paid equity shares of Akash Ganga in full settlement of their dues. So basically, you will have to figure out the PC, which seems to be using net assets. Statutory liabilities are taken over by Akash Ganga at their full value, and trade payables are taken over at 80% of the balance sheet value. So if you take each and every item over here, first they say all current assets of the two companies are taken over by Akash Ganga, and the realizable value of all current assets, including pledged inventory, is 80% of Akash and 70% for Ganga. So if I look at value, this is 80%, this is 70%. Now this is taken over. So this is 72 lakhs into 80% comes to what? I believe 57 lakh 60, and 192 into 70%. 1 crore 33 40. So if I were to review question number, I think 13 must have been done somewhere later, maybe. I think we have done this. Can't really find it, but it is done somewhere. Just a second. So this is 6, 17, 13. Okay, there you are. So 13 over here would be other current assets 5760, 1 crore 34 40. Remember, pledged inventory is not taken over. It is used for settling it off against loan, but that inventory value is also 80%, though it is not taken over. So if you do 368 into 80%, that comes to 29 or 294.4, which will be offset against secured loans. So this is 320 minus 294.4. That's 25.6. What do they mention? Somewhere over here, secured loans agree to continue the balance amount of loans to Akash Ganga after adjusting the realizable value of pledged asset in case of Akash and after waiving off 50% of interest for Ganga. So secured loans will probably be 25.6. If you review over here, this will be 25.6 after adjusting the value of the pledged inventory, and there was 32 lakhs waiving off 50%, that is 16 lakhs will be waived off. So over here you will have whatever is the balance, 1 crore 60 minus 16 lakhs, and hence that is 1 crore 44 lakhs. So this will be your calculation for your secured loans. So point 1 and the secured loan point, PP are taken over at book value, so PP will directly be at 68 lakhs and 136, that is fine. Then you'll have, this is issued for cash, preference shares, this is BC, secured loan we have done. Unsecured loans are taken over at 25% of the loan amounts. So this is 172 into 25%. This is 43. Okay, there you go. This is 43. Next, you will have employees are paid their dues in equity shares, but still they are going to be paid. And hence, if I look at the employee, is there any employee liability somewhere? Yes. 60 and 36. I will take it as it is. I'm issuing shares, yes, but 60 and 36 has to be paid though in shares. Statutory liabilities also will be at book values 144 and 20. This will be exactly the same. But when you look at trade payables, they have been said that this is 80% of the book value. So whatever is the trade payables, which is given, which is 56 into 80% and 36 into 80%. This is given to us. 56 into 80%, 44.8, and 36 into 80% will be 28.8 approximately. Okay, so this will come to your all assets and liabilities. This will ultimately give you the net assets to be taken over. This is a negative net asset. Is that possible? Well, yes. Maybe over here the PC in this case would be we are paying to the preference shareholders 4 lakhs, nothing is paid to the equity shareholders. Further, when I look at Ganga, what have they told? Well, one can say that PC over here was the net assets were negative. For sure, if it is negative, well, you're not going to pay anything for negative net assets. Now, in this particular case, I believe the institute has taken the PC to be nil for Ganga. I would have taken probably the PC to be 41 lakh 60. That is very much possible. Institute has taken this to be nil. An alternative solution is very much possible. So over here, assuming your PC over here is 4 lakhs, there is no PC, sir. I can even take 41 lakh 60 and then I will take the net goodwill or the net capital reserve. Remember, in the balance sheet, I don't need to show both. I will need to show one of the two, and hence the net goodwill or net capital reserve. There will be the net goodwill of 1 crore 54.20. There will be new equity shares issued, liability to be settled by issuing equity shares, and then you will prepare the balance sheet of Akash Ganga. And that takes care of all of these problems. Now, in this I think this was an RTP question, if I'm not wrong. It's a slightly contentious thing regarding net assets. Other than that, everything else does logically make sense. So this is question number 13. Now, before you go to a question number 17 or similar questions on these lines, this is based on the another concept in case of your amalgamation, that is what is going to happen in the books of the selling company. Now remember, the entire acquisition accounting applies in the books of the purchasing company. In the books of the selling company, you will follow what is called as liquidation method. That is, you will prepare an account called as a realization account, where you will transfer all assets and all liabilities. All of them will be transferred except for share capital, equity and preference both, and reserves. Why? Because these are belonging to owners for which you will prepare separate accounts. Equity shareholders account, preference shareholders account. Now, when I'm closing the books of the company, for me, I will have to close my ledgers. And if I have to close my ledgers, the land might be having a book value of 100, fair value of 150. in my realization account, land has to be transferred. So realization account debit to land will be at what value? Sir, will it be at book values or fair values? Sir, if it is in the nature of purchase, at fair value, that is what is taken over. Remember, here you are closing the books. If you are closing the books, in your books the land is worth 100. If you want to close it, it has to become 0. Land has to be credited by 100. And hence realization account debit to assets. This will be at the book values. Further, liabilities, they have to be knocked off. Liabilities will be debited to realization again at book values. So you transfer all assets and all liabilities at book values to the realization account. Step number 1, transfer all share capital items and reserves. Reserves belong to equity shareholders to the equity shareholders account, and if there are preference shares, then preference share capital to the preference shareholders account. So this will make your balance sheet a nullity. All your assets, all your liabilities will be transferred. But for all of this, are you going to get something? Yes. You're not going to do a piecemeal dissolution. Instead, you are going to get purchase consideration from the purchasing company. So you will have P limited account debit to realization. For the entire assets and liabilities, P limited is going to pay some amount. So P limited account debit to realization. So you will create a separate P limited account, and then P limited will pay you the PC, maybe in the form of cash, maybe in the form of equity shares, in whatever form. So equity shares in P account debit, preference shares in P account debit to P limited. So P limited account closes. So at the beginning, what you will do is, in step number 1, to close the books of accounts, you will transfer all assets and liabilities to the realization account. At what values? Book values. Some students make a mistake over here. They transfer it at fair values, in which case your ledgers will show negative balances in certain cases. The only exception over here possible is, let's say for cash, if cash is not taken over, or if cash is going to be used for paying of certain expenses, then you will not transfer cash to the realization as of now. You will show cash account separately. If cash is taken over fully, it should be transferred to the realization. But if S is to incur certain expenses or other cash transactions, then a separate cash account should be prepared. Second step, transfer the balance in equity share capital and all reserves and surpluses or expenses not yet written off to the equity shareholders account, and balance in preference share capital to the preference shareholders account. Okay, now your balance sheet becomes a nullity. Against all of this, P is going to pay you some consideration. Record the PC. That is P limited account debit to realization account. Then receive the PC. That is equity share in P, preference shares in P, cash in whatever it is to P account. And then ideally, before you distribute, we will see that if there is any liabilities which are not taken over, then you'll have to pay that liabilities. Or if assets are not taken over, then you'll have to sell those assets separately. So if there's assets or liabilities not taken over, you'll have to make an adjustment. If there are certain realization expenses that we have to incur, that we have to pay from our pocket, realization account debit to bank. Ideally, it is expense account debit to bank, but all accounts are closed, and hence when you pass this entry, you'll have realization account debit to bank for assets or liabilities which are not taken over and which are discharged. It will be liabilities account debit, ideally to bank, but liabilities closed. Liabilities closed in realization account, so realization account debit to bank. If assets are sold, it is ideally bank account debit to assets, but assets are no longer there, they are closed. So bank account debit to realization account. So over here, sell the assets not taken over, pay the liabilities not taken over with the corresponding adjustment made to the realization account. Next, pay off the realization expenses, if any, entry will be realization account debit to bank. And then, once everything else is done, you will first clear out the preference shareholders. If there is any gain or loss, like 100k preference shares there, we were giving them cash, shares, whatever it is, worth 120, that is 20 rupees more. That is a loss which equity shareholders will have to bear, and hence the difference, if any, on the preference shareholder account will be transferred to the realization account. Distribute the consideration to preference shareholders and transfer the balance in the preference shareholders account to the realization account. And once that is done, you will balance the realization account and transfer the balancing figure to the equity shareholders account. And then ideally, distribute the purchase consideration to the equity shareholders. And after all of these adjustments, equity shareholder has to tally, because now all assets have been transferred, which were not transferred has been sold, preference shareholders have been paid, everything is done. So whatever is the last PC at the end is given to the shareholders and their account will close. So in a full-fledged question, there will be 9 total steps. First, transfer all assets and liabilities at book values in the realization account. Second, transfer share capital and reserves to the equity shareholders account and preference shareholders account, as the case may be. Third, you will pay off the liabilities, and let us say, third, you will record the PC, then you will receive the PC. Fourth, then you will pay off the liabilities not taken over, or recover the assets which are not taken over, pay realization expenses, if any. Then if there's any preference shareholders, close that, take the transfer to realization, balance realization, take the gain or loss on realization, which has to be borne by the equity shareholders, and the equity shareholders account has to tally. So over here, we'll do a question number 17 from the homework section, and then go to the classwork section. So over here, these are the relevant questions in the homework section that you should revise. The other questions you can practice in the homework section. Now, WYE acquires Z, whose balance sheet as on 31st March 11 is as under. So you have been given the balance sheet of Z. So over here, you have this entire balance sheet, notes to accounts. WYE wants to take over all assets except cash. So cash is not taken over. And liabilities except interest due on debentures. So these are the items which are not taken over. And pay the following amounts. This will be your PC. 2 lakhs for 7% debentures in Y for existing debentures in Z limited. For the purpose, each debenture of Y is to be treated as worth 105. This is a part of my net asset working. For each preference share in Z, 10 rupees in cash and 9% preference shares of rupees 100 each in Y. This is a part of BC. For each equity share in Z, 20 in cash and 1 equity share in Y of rupees 100 each having a market value of 140. This is also a part of BC. Expenses of liquidation are to be reimbursed by WYE to the extent of rupees 10,000, but the actual expenses amounted to 12,500, so the additional 2,500 goes from our pocket. WYE valued land and building at 5,50,000, plant and machinery at 6,50,000, patents at 20,000 of Z for the purpose of amalgamation. Now what have we been told? Show accounts to close books of Z. Now even if I have to show these accounts, every time I first need to calculate the PC. PC में payment made to the preference shareholders. How much is paid to the preference shareholders? 10 rupees in cash and 9% preferences of rupees 100 each. So if I look at the preference shareholders, these are 4 lakhs of rupees 100 each. So this must be 4,000 into rupees. So what is the cash? 4,000 preference shares of rupees 10. Can I say this is 40,000? And then there is preference shares. This is 4,000 के सामने another 4,000 preference shares. So this is 4,40,000. And hence total you are paying, I think this is 4 lakhs. And hence total you are paying 4,40,000. Acha, next you look at equity shareholders. We are paying cash for the equity shareholders of 20 rupees in cash. How many equity shareholders are there? 8,000. This is cash. 8,000 of rupees 20. Can I say this will come to 8,000 into 20? 1,60,000 of cash. And then you are issuing equity shares. 1 equity share in WYE of 100 each at the market price. 1 equity share. So this is 8,000 into, I think 140. 8,000 into 140 comes to 11 lakh 20 plus 1 lakh 60, 12 lakh 80 and 4 lakh 40 comes to 17 lakh 20. So this is your purchase consideration, which is worth 17 lakh 20. Okay, so if I review this, this would be 17 lakh 20, 440, 1280, 17 lakh 20. This is your PC. Now, if I were to prepare the accounts, I will first, here they are also asking you to have journal entries, ledgers, everything. So let us, if I look at the journal entry first, I will transfer all assets except for cash. Over here in question number 17, all the assets that I see, PP at book values, intangibles, inventories, trade receivables, everything. Sir, but there are fair values given. Does not really matter. Remember, you have to close the books of accounts, and if you have to close the books of accounts, you have to close it at book values. So over here, your entry will be realization account debit to land and building. As you can see, this is at book values. This is 4 lakhs. Plant and machinery, 6 lakhs. Goodwill, everything except for cash, because cash has agreed not to be taken over. In a similar way, over here, when you look at realization, you will transfer the expenses. So you will have the liabilities. Again, when you look at the liabilities, over here, what all is there? There's 2 lakh worth of debentures, trade payables, and other current liabilities includes interest payable. So over here, well, you can either settle interest payable directly or transfer it to realization and then settle it. So over here, 6% debentures, trade payables, workmen's compensation fund, interest payable. Achha, workmen's compensation fund, like retirement gratuity fund, this is also like a payment, and hence over here this will be transferred. For example, to the extent of 5,000, which is my liability, the remaining is like excess, which is like a reserve. So over here, you will transfer all liabilities. Now, once all liabilities are transferred, what you are going to be left with is share capital and reserves. So you will transfer 8 lakhs, then 1,50,000 and another 3,000 worth of reserve in the equity shareholders account. 8 lakhs, 1,50,000 and then 3,000 worth of reserve in the equity shareholders and preference shares mein pura 4 lakhs will get transferred. So now your balance sheet becomes nil and you will receive PC. So WIE account debit to realization, this will be 17 lakh 20, and then PC will be received. Bank account debit will receive 1 lakh 60 and 40,000, I think 2 lakhs. Equity shares 11 lakh 20, preference shares 4 lakh, and hence we have received these consideration. Now before you go ahead, we will have to pay off these items like interest payable. Well, that account has been knocked off, and hence realization account debit to bank to the extent of interest payable 12,000. So this will be realization account debit to bank. This is for interest payable. Further, cash is there, but well, that is in the form of cash only, but there will be realization expenses. Well, I will actually pay 12,500. So this is, let's say, realization account debit to bank 12,500, but I will recover 10,000. So bank account debit to realization 10,000, and hence 2,500 is the net payment. So if I go to see realization account debit, will be there by 2,500, and WIE will reimburse me around 10,000. Okay, then there are a few other entries. I think that is, see, there is cash to WIE. We have passed that directly. So we will say realization account debit to bank 12,500 and bank account debit to realization 10,000. That's it. So that effect will nullify. Now after that, preference shares are to be settled. So preference shareholders account debit to preference shares in WIE and to cash. This will be 4 lakh and 4 lakh 40. Now preference shareholders account will have a balance of 40,000 will be transferred to realization. Realization account debit to preference shareholders account. Now we'll try to balance the realization account. If you balance the realization account now, there will be a balancing figure of 380 to 500. This will go to the equity shareholders. So over here, realization account debit to equity shareholders 380 to 500. Now whatever is the consideration to be paid to the equity shareholders, we'll pay that. That is equity shareholders account debit to equity shares in Y to cash and bank. And then after all of this, if there's any balance in the cash bank account, that also goes to the equity shareholders account, 55,500. And hence, after all of this, your equity shareholders account should ideally tally. So if I prepare my ledgers in realization, you'll see all of this, all assets, all liabilities. Then if there is any payment of liabilities not taken over, that will also come over there. Realization expenses paid will also come over here, and loss on preference shares will also come over here. When you look at equity shareholders account, all reserves will go. PC is to be discharged. If there's any remaining assets, residual will be paid off to the equity shareholders. Preference shareholders balance will go to the realization account, and all the other accounts will kind of close. Now this is one of the biggest, and I would say one of the most tricky questions, and hence you can mark this as important. Institute has used this as an example to explain the entire working, but because this is one of the very few questions which has everything. It has preference shares, it has realization expense, it has liabilities not taken over, it has cash which is not taken over, expenses which are 12,500, then 10,000, a lot of adjustments. So for selling companies, this is one of the good questions, and hence at the beginning as well, if you are marking your last day revision questions, ensure that you also include this question. and that should take care of the questions within your homework. Next you go to classwork. I think 17 we will put of the homework in the last day revision. This is for the selling company. Now we'll do a couple of other questions for the selling company, which is question number 6 as well as question number 7. In both of these questions, the institute has told you to do the workings, I think, for the selling company. Okay, so let us go to question number 6. Now everything else in the classwork section, please. Go to question number 6. So let us review question number 6 over here. Question number 6. The following is a draft balance sheet as on 31st March 11 for the company Best as well as Better. So it's a small balance sheet given. Following further information is also given. Better issues bonus shares on 1st April 11 in the ratio of 1 share for every 2 held out of reserves and surplus. Who does that? Better is doing that, and that is in the ratio of 1 share for every 2 share held. So basically after the bonus this will be 10 plus I think 5, and this is 8 minus 5. Sir, how did we get 5? Well, if these were 0.1 shares into 1 by 2 into rupees 100. So this is 0.05 into 100 will come to, let us say, 0.05 into 100 comes to 5. That is your entry for bonus. It was agreed that Best will take over the business of Better on the basis of the latter's balance sheet, the consideration being in the form of allotment of shares in Best. So you will take over the business. It was agreed that Best will take over the business of Better on the basis of the latter's. Latter mean the Better's balance sheet, the consideration being in the form of allotment of shares in Best. So this is PC, and PC will be discharged in the form of shares. That is about it. The value of the shares in Best was considered to be 150 and shares in Better were valued at 100 after the issue of bonus shares. The allotment of shares would be made on the basis of these values. So after the issue of bonus shares, actually how many shares would there be? Well, there would be, I believe, I think 0.15 shares, and each of these shares are worth rupees 100. You have been told this is worth rupees 100. So your total PC would be 0.15 into 100 comes to, let us say, 15. And this PC of 15 would be discharged by issuing shares which are worth rupees 150. So this is discharged by issuing shares which is worth 150. So 15 divided by 150 comes to, let's say, 0.1, I think, lakh shares to be issued. This is your PC adjustment. Now the liabilities of Better include 1 lakh due to Best for purchases from it on which Best made a profit of 25% on cost. The goods of 50,000 out of the said purchases remained in stock at the date of the above balance sheet. Now make the closing ledger in the books of Better. So in the books of Better you have to close the books, and the opening journal entries in the books of Best. So here you have been asked both, and also prepare the balance sheet. Oh, that is the entire chapter asked over here. You have to prepare the ledgers in the books of the selling company, that is Better, then the opening journal in the books of Best, and then the balance sheet. So if I go to see, first I will try to find the PC. So when I look at the PC, I believe the PC will be around 15 lakhs. So as you can see over here in full numbers, this is around 15 lakhs, which is to be discharged by issuing shares of 150, and hence this is 10,000 shares. Now this is your PC. Now if I were to prepare the closing accounts of Better, then I will first have the realization account. In the realization account, I will take all the assets, 15, 5, and the liabilities too. So this is 15, 5 and 2, as you can see over here, 15, 5 and 2. Now in the share capital, you will now have equity shareholders, where you will have equity share capital of 15 lakhs and also reserves of 8 minus 5, that is equal to 3 lakhs. So that takes care of the entire balance sheet. Then you have the then you record the purchase consideration that you are going to receive, which is probably 15 lakhs, and then you receive the purchase consideration, which is in the form of equity shares. So this is 15 lakhs, then you receive 15 lakhs, which is the balance. Okay, now there is no preferential holders, there is no realization expense, there is no liabilities not taken over, and hence you will close the realization account. After all of this, there is a 3 lakh rupee loss which goes to the equity shareholders, 3 lakh rupee loss, and then you will try to transfer the PC, which was a 15 lakhs PC, and your account balance. So there is nothing difficult over here. It is just that you have the bonus adjustment, and hence your share capital and reserves will be those after bonus. Then you look at the opening balance sheet. Well, in the opening balance sheet, there would be acquisition entries, business purchase account debit to liquidator, this is at 15 lakhs, liquidator account debit 15 lakhs, to share capital 10 lakhs, to securities premium 5 lakhs, perfect. And then all the assets and liabilities, fixed assets account debit, current assets debit, to liabilities, to business purchase, and then there'll be a capital reserve. Now there's an intercompany elimination, I believe. There's an intercompany elimination of receivables and payables, that is 1 lakh. So there'll be payables account debit to receivables, that is 1 lakh, and there would be a profit of 25% on cost and the goods of rupees 50,000 out of the said purchases remaining in stock. So this is 50,000 divided by 125 into 25 comes to, I think, 10,000, and for 10,000 your entry will be capital reserve account debit to inventories. So over here, capital reserve account debit to inventories, this is for 10,000, and then there is intercompany receivable payables, and using that you will prepare the balance sheet. In the balance sheet, share capital will directly be that 10 lakh rupees of share capital which is newly issued over and above. This is an absorption, so there will be existing 20 lakhs. So 20 and 10, that is 30 lakhs. Apart from that, you will have existing reserves of 10 lakhs. Over and above that, you will have a securities premium of 5 lakhs, and you will have a capital reserve. Your capital reserve initially was 3 lakhs. From that you will subtract 10,000. So this is, I think, 2,90,000. 2,90,000 plus 5 lakhs of securities premium plus 10 lakhs of existing reserves, and there you have 17,90,000. In your current liabilities, you will have intercompany elimination of 1 lakh. In your current assets, you have intercompany elimination of 1 lakh as well as 10,000 for unrealized profit in stock, and that is about it. So there's nothing else which is significantly different over here. Now, next you will go to question number 7. Now, in question number 7, you are going to issue shares at a premium. However, these may be partly paid up shares. So over here, it is possible that your shares have a face value of 10. Let's say the agreed fair value is 15. However, the shares are partly paid and 3 rupees is yet to be paid, which means these are shares of 15. Ideally, they should have given you 15. However, 3 rupees is yet to be paid. It is 7 rupees paid up. And hence, your true value of the share would be that you are issuing, you can still demand 3 rupees. And hence 15 minus 3, that is equal to 12 rupees will be the true value of the share. That is one thing that you will have to remember when you do question number 7. So this is question number 7. We will review this. K Limited and L Limited amalgamated to form a new company, LK Limited. So there are two companies, K and L. Even if you do working for one of them, you will be able to solve for the other one. The financial position of these two companies as on the date of amalgamation was as under. So you have the entire balance sheets given for K and L. The terms of amalgamation were assumption of liabilities of both the companies. So you will take over the liabilities. This is not a part of BC, this is a part of net assets. Issuing 5 preference shares of rupees 20 each in LK at rupees 18 per share. Paid up at a premium of rupees 4 per share for each preference share held in both the companies. So over here, if I look at K, how many preference shares would be there? Can I say there would be 4,000 preference shares? And what is written over here is 4,000 into 5 into rupees what? Well, the paid up value is 18 and there is a premium of 4. So the face value is 20 plus a 4 premium will be 24. But 2 rupees is not paid up and hence the true value will be what? Say 22. So this is 20,000. Sorry. Yes, 20,000 into 22 comes to, I think, 4,40,000. This will be your PC for K. Similarly, will also be done for L. An issue of 6 equity shares of rupees 20 each again in LK at the rate 18, premium of rupees 4 and each equity share in both the companies. So over here, if I go to see, this will be what? 8 lakhs. That is, I think, 8,000 shares. So you will say 8,000 into 6, 48,000 into rupees 22. 8,000 into 6 into 22 comes to 10 lakh 56. This is 10 lakh 56. In addition, necessary cash should be paid to the equity shareholders of both the companies as this is required to adjust the rights of the shareholders in accordance with their intrinsic value of both the companies. Now, this is similar to question number 16 of the homework section where they had told you that this is the shares to be issued, this is the preference shares to be issued, and for the balance pay cash. So how will you find the balance? Well, you will have to find the net assets probably, and after considering 440 as well as 1056, if there is anything else remaining, that will be paid in cash. Now, issue of such amount of fully paid 6% debentures in LK as is sufficient to discharge the 5% debentures in K at a discount of 5% after the takeover. Again, the language over here is a little tricky. Issue of such amount of fully paid fully paid. These are fully paid 6% debentures of LK, as is sufficient to discharge 5% debentures in K at a discount of 5%, let's say after takeover. Now, one of the interpretations over here can be that if these debentures over here are 1,80,000, they will be discharged at a discount of 5%. So, sorry, debentures are 2 lakhs minus 5% will be 1,90,000. This will be a part of your net assets, probably working. The assets and liabilities are to be taken over at book values. Inventory and trade receivables, for which provisions of 2 and 2.5% to be raised. So, inventories, there will be a minus 2%, and for trade receivables, there would be a minus 2.5%. Okay. Next, you will have the trade receivables of K Limited include 20,000 due from L. So that is maybe an intercompany item which on joining will be eliminated by LK Limited. LK Limited is to issue 15,000 shares of rupees 20 each, 18 paid up at a premium of 4 to have sufficient working capital. This is bank account debit to share capital. 15,000 into 22, 3,30,000. Prepare the ledger accounts in the books of K and L to close their accounts. So I'll have to prepare the ledger accounts in the books of the selling company. Nothing is asked in the books of the purchasing company. For everything, you'll have to first calculate PC. So when I look at the PC calculation, let us say for K, well, if nothing is given, you will take over the assets and liabilities at the given value. Now, sir, there is goodwill given over here. Well, if nothing is given, you will take over goodwill as it is. 80,000, 450, 620 for plant and machinery, 60,000 for furniture. Now, when I look at trade receivables, that is equal to, I think, 275 minus 2.5%, 268, 125. Stores and inventory, 225 minus 2%, 2,20,500, and hence you will have a balance plus cash at bank 1,20,000 plus 41,375 minus, so this is 1860 probably, and minus, if you look at your liabilities, there's a 1 lakh rupees of trade payables, and there is a 1,90,000 I believe of this secured debentures. This is 1,90,000. And hence maybe this is 15,70,000. Acha, let us review this. All of this said and done. 2.5%, 2%. Acha, here they have taken 2 lakhs entirely, note 1. Maybe you've written a note over here that we are assuming that these shares are issued at a 10% discount. But in my opinion, an alternative solution and presentation is very much possible. Let us see how it is written. Issue such amount of fully paid 6% debentures in LK as is sufficient to discharge the 5% debentures in K at a discount of 5% after takeover. So one can say that this is 2 lakhs minus 1,90,000 or 2 lakhs or 2 lakhs entirely. Institute probably has taken 2 lakhs over here, and hence this comes to 1560. Alternatively, this can also be taken as 1570. Okay, so this is one place where institute's treatments have not been as consistent. The interpretation over here is involved on whether the issue price is at a discount or whether you are taking it over at a discount, and hence there are two possibilities. A similar working you do and you find 7,90,000. Now, if I look at the PC over here, I believe was, I think, 440 plus 1056, which means this was 14,96,000. However, 15,60,000 was to be the total PC, so minus 1560 will come to, let's say, 64,000, which will be discharged in the form of cash. Now you have to prepare accounts in the books of K. So if you were to prepare accounts in the books of K, similar working will also be done for L. You will transfer all the assets in the same form: goodwill, land, plant, even trade receivables, full value 265, 275, stores 225, everything, even the liabilities at full value, trade payables, debentures. Everything is transferred, and then you take the PC. PC is at 15,60,000, as you can see over here. PC is at 15,60,000, and then you will look at the equity shareholders and preference shareholders account. In the equity shareholders account, you will take the equity share capital of 8 lakhs as well as the profit and loss account of 371, 375. Once that is done, you will go to the preference shares where you will take 4 lakh. Is there any preference share? Yes, you will take 4 lakhs over here in the preference shares. Then you will receive the PC. When you receive the PC, LK will pay 15,60,000 over here. So in the books of LK, there will be 15,60,000. I think I'll have to charge my pencil. Just a minute. 15,60,000. And you can see that this is received in the form of preference shares of 4,40,000, equity shares of 1056, as well as cash and bank. ultimately, if you close the preference shares for 4 lakh, you are paying 4 lakh 40, and hence 40,000 will go to the realization, as we have highlighted in, let's say, gray over here. And once you take that, there's nothing else remaining. You will discharge the PC. You will give the entire equity shares of 10 lakh 56 to the equity shareholders. You will give the cash bank of 64,000 to the equity shareholders, and hence balance the realization account, and the balancing figure in the realization account of 51,375 will come over here in the equity shareholders, and the accounts will balance. So I would say over here only that adjustment of 20 ka share whose paid up value is 18 and issued at a premium of 4, issue price being 22 everywhere, is the relevant adjustment over here. Intercompany elimination of receivables and payables will happen in the books of LK. We are not asked the books of LK. And the new shares issued and money received will also be in the books of LK. We have not been asked anything for LK. Over here in blue, we have kind of written in summary the things that are there for L. So that is regarding question number, I think, 7. Now question number 8 has some impact of internal reconstruction. If you have not yet done internal reconstruction, you'll probably understand this better, and also impact of merger method, which we will do in some time. So this is regarding question 8, which we will come back in some time, because merger method we want to discuss again. Question 9 we have already done. 10, 11 and 12. These are 3 questions which are pertaining to amalgamation in nature of merger, which is pooling of interest method. So when we look at amalgamation in the nature of merger, the method that you will have to use for this purpose is the pooling or joining of interest method. So what happens? Let us say in the pooling or joining of interest method, as we have discussed, over here you will take over assets and liabilities at, you guys tell me, at what value? Sir, book values. Reserves will be taken over, and the difference between the consideration and the net assets, including the reserves taken over, will be adjusted in the reserves. General reserve in the usual case, you will not create a goodwill or a capital reserve. So if the amalgamation in nature of merger, then, sir, how will I know? Well, they will tell you that this is a merger, or they will tell you have to solve using pooling of interest method. Assets and liabilities at book value, reserves taken over, and difference to be adjusted against the general reserve. Okay, so considering that, you will have question number 10, 11, 12, even 8 to some extent has some impact over there. So let us review question number 10. The financial position of 2 companies, Hari and Vayu, as on 31st March 11 was as under. So you have, I think 10 is not there, 11, 12, 13. I think 10 was something else, my bad. So let us finish 10 first and then go to the other questions. The financial position of Hari and Vayu was given. So you have the entire balance sheet. Hari absorbs Vayu. Remember, the question is to tell you merger, pooling of interest or something, only then will you apply that. Otherwise, we will solve using the purchase method only. Hari absorbs Vayu on the following terms. 10% preference shares are to be paid at a 10% premium. Clearly, 10% preference shares to be paid at 10% premium by issuing 9% preference shares. This is a part of PC. So over here, Hari absorbs Vayu. You will have 1 lakh. 1 lakh plus 10% will be 1,10,000. This will be your purchase consideration for preference shares. Goodwill of Vayu is to be valued at 50,000. Okay, and buildings are valued at 1,50,000 and machinery at 1,60,000. So over here, you will have buildings at 1,50,000, machinery 1,60,000, goodwill at 50. So definitely there are a lot of adjustments on the fair value. Next, inventory is to be taken over at 10% less, and provision for doubtful debts created at 7.5%. So inventory will be at 10% less. So 1,75,000 minus 10% will come to, I think, 157,500. And trade receivables, there is going to be a provision for bad debts at 7.5%. So this is, I think, 92,500 net. So you'll have 1 lakh debtors and 7,500 provision for bad debts. Okay. Next, we have equity shareholders of Vayu will be issued equity shares at a 5% premium. How many equity shares? Question does not tell you, which means you might have to calculate BC using the net assets method. Okay. Prepare necessary ledger accounts to close the books of Vayu and show the acquisition entries in the books of Hari. Okay, also show the draft balance sheet after the absorption as on 31st March 11. So over here, if I were to calculate PC, my cash will be 20,000. There is no change over here. So this is what, 50 and 1,50,000. That is 2 lakhs, 3,60,000, 157,500, 92,500 and 20,000. So this is 6,30,000. Then you will subtract the liabilities. If nothing is given, we will assume retirement gratuity fund of 20,000 as well as trade payables of 80,000 will continue as it is, and hence your 5,30,000 will be your total net assets. Out of this, can I say 1,10,000 will be paid to the preference shareholders? 1,10,000 will go to the preference shareholders, and hence the remaining, I would say over here, this is 1,10,000, and hence the remaining, I believe 4,20,000 will be the PC which is going to be issued to the equity shareholders. These are issued at 5% premium, so 10.5 will be the issue price. 420 divided by 10.5 comes to 40,000 equity shares. This round number gives us confidence. 40,000 equity shares of rupees 10.5 each. 40,000 into 10.5. So you see some of the questions involving net assets, some of the questions involving net payments. So when I look at Hari over here, you will see for this particular question, 5,30,000 after all said and done, out of which 1,10,000 is preference, remaining is equity, and payment to the preference shareholders is 1,10,000 and equity shareholders is 40,000 shares of rupees to 10.5 each. Now what is the question asking you? They are asking you to prepare ledger accounts to close the books of value. In the books of value, you will close all the assets at their book values only. 5,70,000 worth. All of this, as you can see, are going to go at book values only. All the liabilities, retirement gratuity fund as well as trade payables will also be taken. PC would be a total of, I think, 5,30,000. This is PC at 5,30,000, and that's about it. In your shareholders, equity share capital, general reserve, and in the preference shareholders, preference share capital. Now, when I receive the PC, I will say 5,30,000 in Hari's books I'm receiving, and Hari will give me equity shares worth 4,20,000, preference shares worth 1,10,000. These preference shares will be distributed to the preference shareholders, and 10,000 will be the profit on profit for the preference shareholders, and hence for the equity shareholders there is a loss. So realization account debit to preference shareholders. Once you do that, you will try to balance the realization account. 50,000 comes over here, which will be to equity shareholders, and whatever is a 4,20,000 PC goes to the equity shareholders, and it should tally. In terms of acquisition entries, you will have business purchase account debit 5,30,000 to liquidator 5,30,000. Then liquidator account debit 5,30,000 to preference share capital 1,10,000 to equity share capital 4 lakhs to securities premium 20,000. So over here, this will be the workings, and all assets and liabilities to be taken over at fair values. Over here, everything will be taken over at fair values. Even cash bank, I believe, was what? 20,000 that will be taken over, and the balancing figure, if any, will be taken to goodwill or capital reserve. In this case, I believe there's no balancing figure because the PC is based on your net assets only. So this was a fairly manageable question, I would say, question number 10. And then you go to 11, 12 and 13. Following are the summarized balance sheet of yes and no. Very innovative names. As on 31st October 2014. So you have the balance sheets of yes and no as on 31st October 2014. And you have been told on that day yes absorbed no. So yes is the acquirer, no is the target. The members of no are to get 1 equity share of yes issued at a premium of 2 rupees for every 5 equity shares held by them in no limited. The necessary approvals are obtained. So this is going to be a part of PC. So the shareholders of no have how many shares? 5 divided by 10. So this is 0.5 crore shares. And you have been told that you are going to get 1 equity share of yes for every 5 shares of no. And hence you are going to get 0.1 crore shares at the rate rupees 12. And as a result, this will come to 12 because it is a 20 premium of 2 rupees, and hence 0.1 into 12 will come to, let us say, 1.2 crores. Are we clear with this? So this will be your purchase consideration, which will be recorded, let us say, at 1.2 crores. Okay, आगे देखो, you are asked to pass journal entries in the books of the 2 companies to give effect to the above. Okay, again, this is there in the study material as well, considering amalgamation in the nature of merger. Now, you have been specifically told amalgamation in the nature of merger. Now, in the books of no, it does not really matter whether it is merger or it is purchase, because no closes. So, no will create a realization account, and in realization will transfer all assets, all liabilities. In shareholders, it will transfer share capital and reserves, record the PC, and then find the balancing figure. So, you will have realization account debit to assets, which can be, let's say, fixed assets of 30, or you can say the net amount at 6, and current assets of 34. So if I go to see for question number, I think 15 बाद में देखते हैं. Where is 16 also is there. We'll go in the sequence 20. Okay, finally you have 11. So you have PC of 1.2 crores as we discussed, and then in the books of no, you will have realization account debit to fixed assets 30, to current assets 34. Then realization के अंदर liabilities will be transferred, so there will be provision for depreciation, which is 24. Even unsecured loans will be transferred 10. Everything, current liabilities 15, and that will go to the realization. Next, you will receive the PC and record the PC. So this is a yes account debit to realization 1.2 crores. And then you will receive the PC equity shares of yes account debit to yes limited. Now over here, you will also transfer the equity share capital as we said and the reserves. So this is 10 as well as 5 to the equity shareholders account, equity share capital and reserves 5 and 10, that is 15. And then there are no preference shares. All said and done, you will try to balance the realization account. 64 on the debits, 49 on the credits, and another 1.2 on the credits. So if you take the balancing figure, it is around 13.8, which will be on the credit side of realization. So this is equity shareholders account debit to realization, and then that will take care of no. My point is, further they have said that you also pass entries in the books of yes. Now in the books of yes, there is a merger method, and under merger method what will happen is the first entry is the same, business purchase to liquidator 1.2, then liquidator account debit to share capital to securities premium, simple. However, now when you take over the assets, you will have assets of note to be taken over at book values. So this is PP, book value, net book value is let us say 6 rupees, PP account debit 6 rupees, current assets account debit 4 rupees, 34 rupees. 2, you will also credit the liabilities. I think liabilities were worth 10, 20, 10 and 15. So this is to current liabilities 15, to unsecured loans 10, which will later be eliminated, but you will take this over. Now you will also take over the reserves because it is amalgamation in the nature of merger. You will also take over the reserves, and we have written that with a different color pen. So over here, this reserves of 10 will be taken over to business purchase is 1.2, and hence there will be a balancing figure. Now usually you show this balancing figure as a capital reserve. In this case, you will take it as a general reserve or adjustment to the reserves of around 3.8. So finally, when you show the reserves along with your existing reserves, for example of 88, you will also have 10 and another 3.8. So this is 88 plus 10 plus 3.8, which will be 101.8 probably. Intercompany loans will be eliminated. If a balance sheet was asked, then you would have taken these reserves and prepare the balance sheet. Okay, so this is question number 11. 12 is a very basic question. I would say it is reading the question and completing it. So Super Express and Fast Express were in competing business. They decided to form a new company called a Super Fast Express, and the summarized balance sheets are as under. So you have the summarized balance sheet for Super Express and then the summarized balance sheet for Fast Express. Now when you look at Super Express, you have equity shares, provident fund. Remember, this is a liability. Provident fund is a liability. It has to be paid to the employees. Trade payables, insurance reserve. Insurance reserve over here, institute has assumed it to be a reserve. We will also treat it as a reserve. Employee profit sharing account, trade payables, reserve account, and then surplus. Now, employee profit sharing, we are not very sure. If you see the study material, they have clearly classified whether this is a reserve or not. So these two items are relatively new, but the assets and liabilities of both the companies were taken over as by the new company at their book values. The companies were allotted equity shares of rupees 100 each in lieu of the purchase consideration amounting to 30,000, that is 20,000 for Super Fast Express and 10,000 for Fast Express. Prepare the opening balance sheet of Super Fast Express. Okay, so over here, what you have to do is, आगे देखो क्या लिखा हुआ है, as per pooling of interest. Even in the study material, earlier this was not there before the May 25 material, and created a lot of confusion among students that when do I use pooling of interest, when do I use the purchase method. With this data being given, you need to remember that you can safely use the pooling of interest method, that is amalgamation in nature of merger. So you have to prepare the opening balance sheet. What will I do? Well, I will just total buildings 10 and 6, that is equal to 16. Then you have machinery 4 and 5, that is 9. Inventories 40 and 3 lakhs, that is 3 lakh 40, and so on. Will I also take over the reserves? Well, yes, even reserves will be taken over. And in lieu, PC will be paid. PC will be 20,000 shares and 10,000 shares, 20,000 into 10, that is equal to 20 lakhs to Super Express, and 10,000 into 100, that is equal to 10 lakhs for a Fast Express. So if I go to see over here, it's a very, very basic question. Question number 12, for Super Express, you have 20 lakhs SBC, Fast Express 10 lakhs SBC. Assets minus liabilities minus reserves are also 20 lakhs and 10 lakhs, and hence there is no goodwill. I mean, goodwill to वैसे भी नहीं होगा. There's no separate reserve adjustment. What you are paying is exactly equal to the assets minus liabilities that you are taking over. Now, when you look at the total, you are just going to total each of these items as it is. So when I look at the reserves, I will total up the reserves, which is, I think, यहाँ पे कितना है? There is only 1 lakh. Then you have 1 lakh, and even 60,000 was taken as a reserve by the study material. They have given you in the reserves and surplus. In this question, it is not given in that clear format, but if you have the study material, you can see that it is given within reserve. So we will respect that. So this is 2 lakh 60 and 1 lakh. Total is 3 lakh 60 worth of reserves. And share capital will have 20 and 10, 30,000 shares at the rate rupees 100, that is 3 lakhs. Other than that, it is a direct totaling up of each of these assets and each of these liabilities at book values only, because this is pooling of interest method. Are we clear with this? Question number 12. Yes, sir. Maja aa raha. Question number 13. This is the question regarding pooling of interest, which you can mark as important and review for your last day revision. Now, the following were the summarized balance sheets of P Limited and V Limited as on 31st March 15. The balance sheets of P and V being given to you. All the bills receivable held by V were P's acceptances. So these are intercompany, you will have to eliminate. On 1st April 2015, P took over V in amalgamation in the nature of merger. Is a question very clearly telling you? In the amalgamation in the nature of merger, yes. So we don't have to kind of take that acquisition method, we'll take pooling of interest method. It was agreed that the discharge of consideration for the business of P would be 3 fully paid equity shares of rupees 10 each at par for every 2 shares in V. It was agreed that 12% debentures of V would be converted into 13% debentures of the same amount and denomination. This is PC, this is net assets. And ऊपर जो आप देखो, this is intercompany elimination. Okay, the details of trade receivables and trade payables were as under. You have been given details of each of them, and expenses of amalgamation amounted to 1 lakhs were borne by P. You are required to pass journal entries in the books of P. Now for that you will first have to calculate PC. Now PC is 3 shares at par for every 2 shares held in V. So if I go to see, there were how many shares in V? Maybe 600 equity shares of rupees 10 each. So your PC over here would be 600. When I take the PC, maybe this will be 600 into 3 by 2. These are the number of shares, I think 900 to be issued of rupees 10 each. So can I say 9,000 will be the PC? Okay, 9,000 will be the PC. Okay, you are asked to pass the journal entries in the books of P. So in the books of P, it is business purchase account debit to liquidator of V. This will be at 9,000. And then liquidator of V account debit to equity share capital 9,000. Nothing new over here. Now when you take over assets and liabilities, you take over all assets and liabilities of V. Plant and machinery, furniture and fixtures, inventories, trade receivables, cash at bank. Achha, cost of issue of debentures. Remember, this is not really an asset, it is an expense, more like a reserve item. You will knock it off against the profit and loss. So you will have, other than that, you will take over provisions, trade payables, and even debentures. And in my P&L, I will say 825 minus 50. There is some fictitious asset, and hence 775 will be my net profit and loss balance. If I go to see, I will take over all assets, all liabilities. But will I also take over the reserves? Yes. These 3 reserves, whether it is foreign project reserve, general reserve, as well as P&L account, will be taken in the same form: 310, 3,200 and 775. To business purchase will be 9,000, and then you will see if there is a balancing figure. Now this is an important thing. Over here, you will have foreign project reserve, general reserve and P&L taken over, and then business purchase, and then there is a balancing figure which we will adjust against general reserve because it is a pooling of interest method. So your final general reserve, if I go to see, would be your general reserve of P, which was there at 9,500, plus you will take over 3,200 minus 3,000. and hence this will be your final balance of general reserve ideally. But there is also an expense of amalgamation which is usually adjusted against goodwill or capital reserve. In this case, it is happening due to a pooling of interest, and hence will be adjusted against general reserve. This general reserve account debit to bank, and hence over here this will be general reserve account debit to bank, and hence this will be a further -1. So this will be what, 9,500, and is this 9699 final reserves, and then prepare P's balance sheet immediately after the merger. Other than that, there will be some intercompany elimination as well, where they say all bills receivable held by V were P's acceptances. Held by V, bill receivable held by P, this is 80, were P's acceptances, so intercompany elimination will be at 80. So if you go to see over here, bills payable account debit to bills receivable at 80, and then you will have general reserve account debit to bank, this is 1. Debentures, 12% debentures debited to 13% debentures credited, and based on that you will prepare the balance sheet. Now while preparing the balance sheet, the problem will be in reserves. Now when I look at reserves, you will have the securities premium, let us say as it is, which was there over here. Then foreign project reserve will be at 310, general reserve will be 9699, and PNL will be 2870 plus 775, 3645, 9699. And that will give you the reserves. Everything else is a direct line by line addition. Is everyone clear with this? Yes, okay. So this kind of takes care of question number 13 as well. Now before you proceed further, if we even wrap up question number 8, which was a sum total of internal reconstruction and of merger. Now if you have not done internal reconstruction, probably you can come back to this question after internal reco is done. But if you have done internal reconstruction, what happens in case of internal reconstruction? There's usually a capital reduction. How will I know in a question where there's a hidden internal reconstruction scheme? Well, if there is a reduction of share capital. Remember, the only way you can say that there's a reduction of share capital is if there was a court approved internal reconstruction scheme. Only then can we say that there is a reduction of share capital. So over here we'll have to prepare the capital reduction account or a reconstruction account and find the gain or loss on account of that. So we'll read question number 8 on those lines. Okay. Now following are the summarized balance sheets of A and B as on 31st March 11. So you have the summarized balance sheets of A and B. B has acquired the business of A. B over here is the acquirer, A over here is the target. The following scheme of Aja, what is it written? Merger. If it is merger, the word merger is written, you'll have to use pooling of interest. Even institute over here has used pooling of interest. Was approved. Now banks agreed to waive off 60,000 of loans of B. Now that is pertaining to B. Point 1. B will reduce its shares to rupees 10 per share and then consolidate 10 such shares into one share of rupees 100 each, which is a new share. You will highlight this. See, B's current face value of the share is how much? Well, B's current face value of the share is rupees 100 each. Now they are saying in adjustment 2 that what we will do is we will reduce the face value of this share to rupees 10. Now the only way you can reduce the face value of this share is by a capital reduction scheme. Share capital's reduction of face value is not permitted unless there was a scheme of capital reduction or internal reconstruction approved. So this adjustment tells you that there is a hidden internal reconstruction over here. And then you will do a share consolidation as well, which is also something that you will do in internal reconstruction chapter. Now shareholders of A will be given one share, which is a new share of B, in exchange of every share held in A. So this is a 1:1. One new share after the capital reduction as well as share consolidation of rupees 100 each for every share held in A. So this is your PC working. And trade payables of B include 100,000 payable to A, intercompany. Pass the necessary entries in the books of B and prepare the balance sheet after the merger. Now for these entries, before I go into the acquisition entries, I'll have to do the internal reconstruction of B. So under internal reconstruction, the first entry will be, let us say there are loans. So this is loans account debit 60 to capital reduction 60. So this is 450 minus 60. Then equity share capital account debit 1000. These are shares of rupees 100. To equity share capital, these are shares of rupees 10, that is 100. and to capital reduction. This will be 900 rupees. But remember, in the capital reduction scheme, there will always be an accumulated loss. The objective of this scheme is to write off the accumulated loss, and hence even if it is not specifically given, you will have to write off these losses. So over here there will be capital reduction account debit to accumulated losses. This is 800. So if I were to prepare the capital reduction account, on my credits I would have 60 and 900, that is 960, and on the debits I'll have 800, and hence 160 balance which remains, which will go to the capital reserve. Okay. Other than that, there is a share consolidation, the entry for which is equity share capital of rupees 10 account debit to equity share capital of rupees 100. So now what will happen is, now you earlier had 10 shares of rupees 100 each, then it became 10 shares of rupees 10 each, and then ultimately it will be 1 share of rupees 100 each. Are we clear with this? So this is equity share capital which was 100 to equity share capital of 100. This is share consolidation. Now if I look at question number 8, I think this is done along with capital reduction in or internal reconstruction, maybe somewhere at the end over here, if I can find it. Yes, question 8 of amalgamation, where you will first do internal reconstruction, capital reduction, and then you will have the balance of capital reduction being transferred to the capital reserve, which is 160. So after all of this, the balance of capital reduction will be transferred to 160. Now for the shares of A, 1 share is issued. So basically 2000 divided by 100, there are 20 shares. For these 20 shares, we will issue 1:1, 1 new share of rupees 100 each, and hence PC will be 2000. As you can see, your PC will be 2000, that is 20 new shares of rupees 100 each. The merger entries will be business purchase account debit to liquidator of A, business purchase account debit to liquidator of A over here, and then liquidator of A to equity share capital. Then you will take over all assets and all liabilities of A, that is fixed assets debit, investments debit, trade receivables debit, cash at bank debit, to loans credit, to debentures credit. Acha, will I also take over the reserves? Yes, because this is a merger. To reserves 1000, to business purchase 2000, and then you will see if there is a balancing figure. So over here reserves are taken over at 1000 to business purchase, and there is no balancing figure. Coincidentally it kind of tallies, it is not necessary, it has to tally. Okay, and then you will eliminate the intercompany trade payables and receivables. Now based on that you need to prepare the balance sheet. So if I were to prepare the balance sheet, यहाँ पे क्या आएगा? The balance sheet would be, over here I will have fixed assets of 2700 plus 850, this is 3550, direct merger investments of 700, trade receivables 550, cash 250. There is no accumulated losses. In your share capital you will now have shares of 100. To that you will add 2000, which is issued as a part of PC. So maybe this is 2100. In your share capital, reserves of 1000 will be there as it is. Along with that, there is a capital reserve, I think, of 160, and hence this is 1160. Then you will have 10% debentures of 500. Acha, in trade receivables, sorry, I will subtract minus intercompany of 100, and hence this will be 450. There is loans from banks. This is 250 plus, I think, 390, 640, bank overdraft continues at 50, and trade payables 300, 300, 600 minus 100, that is equal to 500. And that's about it. So this is 2100, 1160, 500, 640, 50 and 500. Maybe 4950, and even over here 3550, 700, 450 and 250, 4950. So over here, if you go to see, this will be 4950. The challenge over here will come in your reserves of 1160, your amalgamation in the nature of merger. So your 1000 reserves continue, and at the same time 160 that arises at the stage of internal reconstruction. Are we clear with this? So this is a good blend, this question, between question number between internal reconstruction as well as amalgamation. That is question number 8 done. You will mark that as important. Now after you are done, you have question number 14. I think that's a manageable question. 14, 15, 16, 17 I think we have already discussed. 18, 19 is already done, and then there is 20. 21 ke aage bhi it is done. So there are just a few questions. Let us quickly wrap that up and get done with our amalgamation. So let us review question number 14, please. The following are the summarized balance sheets of X and Y. So you will have X and Y summarized balance sheets. A new company XY is formed to acquire the sundry assets and trade payables of X and Y, and for this purpose the sundry assets of X are revalued at 1 lakh. Sundry assets of X are revalued at 1 lakh. The debt due to X is also to be discharged in the shares of XY. Now, this is a debt due to X is also to be discharged in the shares of XY. Show the ledger accounts to close the books of X. Now, we don't have to bother about Y. We have to bother about X. Now, do I have the PC? Well, no. But PC over here ideally would be based on net assets. So what will be the net assets? Well, sundry assets, I believe, of 1 lakh. वैसे बोलने के लिए loan है, but that is separately discharged, let us say. Then you have over here on your liabilities, I think trade payables. So can I say 75,000 would be the PC? So I'm not sure whether I can find it over here, but I think 75,000 should be a part of my PC. This is 15. I think it directly kar diya hoga. So let us say, I'll just discuss this directly. 75,000 will be a part of my purchase consideration. Aja, the debt due to X is also to be discharged in the shares of XY. So maybe this is separately discharged in the shares of XY. Show the ledger accounts in the books of X. In the books of X, there will be a realization account. In the realization account, you will transfer sundry assets worth 1,20,000. You will transfer trade payables of 25,000. Then you will have an equity shareholders account. In your equity shareholders account, you will transfer the share capital and the profit and loss 1 lakh, as well as I think 10,000. This is what you will transfer. And then you will have a loan to Y. Now loan to Y will have a balance of 15,000, which is going to be separately discharged. So I will receive shares, equity shares, to discharge this. So this is done. Other than that, for this business, there will be 75,000 worth of PC. I'll receive this 75,000 in the form of shares, and then I will try to find the balance. The balance over here will be 20,000 on the credit side of the realization. This will come over here 20,000, and यहाँ पे आपको 75,000 मिल जाएगा. So if I go to see, there would be 1 lakh P&L balance of 10,000, that is 1,10,000. When you look at, let us say over here, just a second, this was 1,20,000. Yes, and this is 1 lakh. In equity shareholders, this is 1,10,000. My PC, I believe, would have been 1 lakh minus 25,000, that is 75,000 maybe. Sundry assets, okay. And loan to X, 15,000 tha. I will receive equity shares 75,000 towards the business and another 15,000 towards discharging this loan. This 15,000 I will use to discharge against the loan, and then I will have the remaining 75,000 to be settled over here. Barabar. It's 1,10,000. 1 second. So over here, when you will say the total number of shares to be received, over here this is to balance, and there will be equity shares in the new company XY. Now for the business, the equity shares that will be received as a part of the realization transaction will be 75,000, and against the loan, but shares to be received, this will be to loan another 15,000, and hence total of 90,000 shares will be distributed to the equity shareholders, and hence over here along with 75 for the business, another 15 for the loan, and totally you will get 90,000. And this is how your accounts will kind of balance, because in this loan your loan account closes. However, you are going to receive another 15,000 shares along with the 75,000 shares in lieu of business, and hence a total of 90,000 shares which are received is distributed to the shareholders. So that is question number 14. Next you go to question number 15. Now the following is a summarized balance sheet of A as on 31st March 15. So you have the entire balance sheet. यहाँ पे भी last में there is some share issue expenses. B, this is balance sheet of whom? Sir, A. B agreed to absorb A, but you have not been given B's balance sheet. Now a very unique question was there in one of the RTBs that you are agreeing to absorb, B is agreeing to absorb A, but B's balance sheet itself is not given. And the following terms and conditions: B would take over all assets except for the bank balance at their book values less 10%. So all assets except for the bank balance at book values less 10%. Goodwill is to be valued at 4 years purchase of super profits, assuming the normal rate of return to be 8% on the combined amount of share capital and general reserve. So if I look at the combined amount of share capital, that is 8 lakhs, and general reserve, let's say 80,000 for the time being. So this is 8 lakh 80 into 8%. This will be 70,400. This will be your normal profit. So normal profit would be 70,400. B is to take over trade payables at book values. So they have said that B will take over all assets and then B will take over trade payables at book values. So okay, they will take over trade payables. Maybe nothing is given regarding debentures. The purchase consideration is to be paid in cash to the extent of 6 lakhs and the balance in fully paid equity shares of rupees 100 each at 125 per share. Abhi kitne shares? Maybe that is based on net assets. The average profit is 124,400. So maybe net profit was 70,400, but the average profit is 124,400. 124,400 minus 70,400. Super profit may be 54,000 and 54,000 into 4. Can I say goodwill will be approximately 2,16,000? The liquidation expenses amounted to 16,000. B sold goods prior to 31st March 15 costing 1,22,000 A for 1,60,000. So 40,000 is the profit. 1 lakh worth of these goods are still in inventory. So you'll have to find out how much of these goods are still unsold and unrealized profit. So basically 40,000 divided by 1,60,000 into, that's a 25% profit margin, into 1 lakh. I will say 25,000 I believe of the profits are unrealized. This is 40,000 of profit on the base of 1,60,000 and only 1 lakh worth of goods are unsold. So 40,000 upon 1,60,000 into 1 lakh. On 31st March 15, trade payables of A include 40,000 still due to B. Trade payables of A include 40,000 still due to B. So that's an intercompany elimination. You are required to show the necessary ledger accounts to close the books of A and then prepare balance sheet of B as on 1st April 15 after the takeover. Now you will not be able to prepare the complete balance sheet because you don't have the balance sheet of B. So to the extent available, we will take the data of A and prepare the extract of the balance sheet. But at least to close the books of A, I need to find the PC. Now PC ke liye, we have been told that all assets except for cash have to be taken over. And this is at 10% lower value. Goodwill is valued at 2,16,000. Trade payables will be taken over at book values. This is not in the nature of merger and hence pooling of interest will not apply. Now the problem is 10% debentures and loans from A. Is the question telling you anything in this regard? Well, you have two assumptions. You can say that these two are also taken over, or you can assume that they will not be taken over. So in this particular case, what we will do is we will try to first find the net assets. For PC, you will subtract everything minus 10%. Building, machinery, inventory, trade receivables. Bank you will not take over. Goodwill 2,16,000 you will calculate and less trade payables. So for loans of A and debentures, they have not told you. They have told you all assets are taken over and then trade payables are taken over at book values. Institute over here has assumed that since nothing is given regarding debentures being taken over or nothing is given regarding loans specifically being taken over, they have not been taken over and hence they will be separately paid off. So over here this will be your PC 12,10,000. This PC of 12,10,000 will be discharged in the form of cash 6 lakhs and the remaining 6,10,000 in the form of shares at 125 and hence this is 4,880 shares. Over here if you go to see, this will be 4880 shares of rupees 125 each, 12 lakh 10,000. Now you are asked to prepare the closing accounts of A. In the closing accounts of A, you will have in realization, you will transfer all assets, all liabilities, including, there are alternative presentations, but you can even transfer debentures and loan, or you can prepare a separate account, whatever is comfortable. So let us say you transfer all assets and all liabilities. Cash bank, you can prepare a separate account because that is not taken over. So over here, you can say that you have transferred all assets at the full book values, including goodwill. Then debentures also transferred, loans also transferred. Alternative, separately show an account for these because they have not been taken over. Either ways works, ultimate answer is the same. And then trade payables. Then in your share capital, you will transfer share capital, reserves, as well as share issue expenses. So your balance sheet becomes nil. Then you will receive the PC of 12 lakh 10,000. This PC will be in the form of cash and in the form of equity shares in B. So equity shares in B 6 lakh 10. Cash opening was 1 lakh 36, which was not taken over, and then 6 lakhs over here, which is received. Now ideally I now pay realization expenses. Are there realization expenses? Yes. They have told you that the liquidation expenses amounted to 16,000. We are assuming that is paid over here. So this is realization account debit to bank 16,000. This is for realization expenses. Other than that, we will have to assume that these debentures as well as these loans must have been paid off. So these debentures and loans have been paid off out of the cash balance. Realization account debit to bank. Had you prepared a separate ledger for debentures and loans, then it will not come in the realization. However, there will be a separate debenture account and a loan account. Within that, you will have to bank. Okay. Now, after all of these adjustments are done, well, you will try to balance the realization account, and the balance in the realization account of 76,000 will go to the equity shareholders account, and then whatever is the PC, which is 6 lakh 10,000, as well as whatever is the remaining cash of 1 lakh 60,000 will be distributed over here, and that is about it. Okay. Now this is in the books of the selling company. As we have seen, alternatively you can show the 10% debenture separately, not take it to realization. There will be a balance, and then to bank will come over here. Okay, यहाँ पे देखिए रिलेशन पे कोई फर्क नहीं पड़ेगा because then you will not have this 4 lakhs over here, you will not even have this 4 lakhs over here, so the effect will remain the same. If you are showing a separate account, the payment will also be shown from that account, so your ultimate impact on realization will not be anything. Now other than that, what is the question also asking you? They're asking you to prepare the opening balance sheet. Now the problem is you don't have all the data to prepare the opening balance sheet. शेयर कैपिटल टू द एक्सटेंट 4,88,000 यू विल टेक. रिजर्व जितने बी के हो गए वो भी हमें टेक ओवर करने होंगे. एज सेपरेट रिजर्व्स शुड बी देयर. नाउ बी इज अक्वायरिंग ए, राइट? B's reserves we don't know. A's reserves we cannot take over. Trade payables has a 40,000 intercompany elimination. In intangibles there will be a goodwill of 2 lakh 16. अच्छा यहाँ पे अच्छा 15,000 addition is unrealized profit. 15,000 20. Oh, there is a very good adjustment over here. The adjustment over here, usually my unrealized profit on stock would be 25,000, but the question has told you that B would take over all assets at their book values less 10%, which means if I look at inventories, the inventories over here would have been taken over at 2 lakh 20 minus 10%. Within that 2 lakh 20 inventory, there's a 1 lakh rupees inventory, which would have also been taken over at 10% lower. And as a result, when I look at the inventory which is still there, I don't have an inventory of 1 lakh, I have an inventory of 90,000 effectively. And if my profit was 25,000, that is on a 1 lakh inventory, the cost would have been 75,000. profit was 25,000, but my inventory is shown at 90,000 only, and hence I'll have to make an adjustment for 15,000. So this is an important adjustment. I think in the study material also there's the last question where this adjustment is there. So there's an unrealized profit in stock of 25,000. However, so your inventory is taken over as 10% less. So 1 lakh inventory must have been taken over at 90,000, and hence inventory taken over at book value less 10%. So your inventory is only appearing at effective 90,000, and hence you will make an adjustment of 15,000, and for this your entry over here would be goodwill account debit to inventory. So yes, you will credit the inventory by 15,000, but at the same time you will debit the goodwill around with the 2,16,000 goodwill plus 15,000 will be 2,31,000, and in inventories you will subtract 15,000. The adjustment for 15,000 over here is very important, which is there unique to this question only because here there's an unrealized profit in the inventory, and also the inventory is taken over at a 10% lower value. Both of them come together only in this question. So whenever such an adjustment comes, you will go back to this adjustment of question number 15. Okay, perfect. So this is question number 15. For other assets like trade receivables, there'll be a regular intercompany 40,000 elimination, and that's about it. Cash is not taken over. I will not be able to total the balance sheet because I don't have enough data. That is question number 15. Specifically, this adjustment I would say will be an important, where 25 minus 10, which is equal to 15. When will this adjustment come? If there's an unrealized profit on inventory and the inventory is taken over at a value which is less than its book value. Okay, then you have 16. The financial position of X and Y as on 31st March 18 was as under. So you have the balance sheet of X and Y. X absorbs Y on the following terms. Again, this is an exam question. X absorbs Y. Well, you have to prepare the realization account in the books of Y, journal entries in the books of X, who is the acquirer, and then balance sheet in the books of X after absorption as on 31st March 18. So let us look at this. 10% preference shares are to be paid at a 10% premium by issuing 9% preference shares of X. So these are preference shares to be paid at a 10% premium. So can I say this will be a part of PC at 3,30,000. Next, goodwill of Y on absorption is to be computed based on 2 times of the average profits of the preceding 3 financial years. You have been given this, and the profits of the year 14-15 included credit of an insurance claim of 25,000. Now this is an extraordinary item. Fire occurred in the year 13-14, and the loss of fire was 30,000 was booked in the profit and loss of that year. In the year 15-16, there was an embezzlement of cash by an employee of amounting to 10,000. Now these are extraordinary items. When you calculate goodwill, you will calculate the normal profits. This is in the year 16-17, 90,000, no adjustment needed. In the earlier year 15-16, this is 78,000, but 78,000 was after. No, 15-16, this was after embezzlement of cash of 10,000. So before that, your normal profit was 88,000. There was a 10,000 extraordinary loss, which will reverse. And in the year 14-15, 72,000 included an extraordinary income of insurance claim of 25,000. 72 minus 25 comes to, I think, 47,000. So over here, if I were to take all of this and then divide it by 3, can I say my average profit would have been 75,000? You have been said that goodwill is 2 times of the average profit, not the super profit. So 75 into 2 must be 1,50,000. So if I go to question number 16, we will calculate the adjusted profits, which is 90, 88 and 47. Average profit comes to 75 into 2. This is 1,50,000. So these are questions where there can be one of goodwill adjustments which are asked. Acha, land and buildings are valued at 5 lakhs and plant and machinery are valued at 4 lakhs. Land and building, so over here 75 ke badle your goodwill we have just calculated will be 1,50,000. Land and building valued at 5 lakhs. Plant and machinery 4 lakhs. Okay. Next, inventories are to be taken over at 10% less value and provision for doubtful debts is 2.5%. Inventories will be taken over at 10% less, 525 minus 10%. अच्छा तो यहाँ पे भी वो 470 to 500 आ रहा है. So if there is an adjustment similar of unrealized profit, तो यहाँ पे भी वो 10% का adjustment आ सकता. And debtors पे 3 lakhs minus what is the provision for bad debts? 2.5%. to 292,500. Okay. So this is done. There was an unrecorded current asset in the books of Y whose fair value was 15,000 and such asset is to be taken over by X. So over and above all of this, I will also have an unrecorded asset worth 15,000. Cash to वैसे ही 60 का 60 आएगा if there is no change. And there's an unrecorded asset of 15,000. The trade payables of Y included 20,000 payable to X, that is intercompany, and equity shares are to be issued. Equity shares at 5% premium. They have not told you how many shares. Whenever they don't tell you how many shares, well, your total consideration will be based on the net assets. Okay. Prepare the realization account. Over here, if I look at your liabilities, there is a trade payable of 240 and retirement gratuity fund of 60. So this is minus 60 minus 240. And hence, if I total up, this is 150 of goodwill, 5 lakhs and 4 lakhs, this is 9 lakhs, plus 472 500, plus 292 500, plus 60,000, plus 15,000, less, I think 3 lakhs. So can I say 15 lakh 90? So your consideration overall will probably come to 15 lakh 90, which are to be settled by issuing shares at a 5% premium. Abhi shares ka value kitna hai? I think 10 rupees. At a 5% premium, this is 15 lakh 90, out of which 3 lakh 30 is settled to preference shares. So 15 lakh 90 minus 3 lakh 30 to preference shares, and hence you are left with 12 lakh 60 divided by 10.5 shayad se, and hence 1 lakh 20,000 shares. So over here, all said and done, you will get net assets of 15 lakh 90, which is attributable to preference shares as well as equity shares. So over here, the remaining 12 lakh 60 will go to the equity shares, and this is 1 lakh 20,000 equity shares of rupees 10.5 each. So in your share capital in preference shares, you will have 3 lakh 30,000 shares. In equity shares, 12 lakhs and 60,000 will go in the premium. Now you are asked to prepare the realization account. You will transfer all the assets at book values, including cash bank because there is nothing else, and all the liabilities also. Then you will have 15 lakh 90 over here as the PC, and just realization is asked. So, well, to the preference shareholders, there will be a separate loss, and other than that, the balancing figure will go to the equity shareholders. If you are asked to prepare ledgers in the books of the selling company, then you could have prepared the other ledgers. Here you are only asked realization. Then in the books of the purchasing company, business purchase account debit to liquidator 1590, liquidator account debit to equity share capital 12 lakhs, to preference share capital 3 lakh 30, to securities premium 60,000. ये 12 lakh के ऊपर 60,000 का premium है. And then all assets you take over. Remember, this is not in the nature of merger. Question is silent, so it is in the nature of purchase. In fact, there are so many fair value adjustments. It will be in the nature of purchase. And you will get all of this, including the other current assets. There will be no other balancing figure because your PC is already based on the net assets only. And after that, you will have a trade payable, trade receivable, intercompany elimination. There is no unrealized profit. If there was, then an adjustment similar to question 15 would have been done. And then you will total up all the items in your balance sheet like you have done earlier, and there will be a separate other current asset as well, and that will give you the balance sheet. Okay, so the last question now finally would be the question of 20, which is on external reconstruction. Now in external reconstruction, what happens is one company closes and we are reorganizing, and a new company is formed to acquire the reorganized business. So question number 20 pertains to external reconstruction. Now Mohan Limited gives you the following information on 31st March 2020. Now this is information given by Mohan Limited. A new company Ravi Limited is formed with an authorized share capital of 4 lakhs divided into 40,000 shares of rupees 10 each. The new company will acquire the assets and liabilities both of Mohan Limited on the following terms. So you have all of this data given. Last, you are required to prepare the realization account and the equity shareholders account in the books of Mohan, that is the selling company, and then the bank account and the balance sheet in the books of Ravi Limited. Fair enough. So over here, if I go to see, you have to prepare the realization account and equity shareholders account, for which you will again need to find the PC. Mohan's debentures are paid by similar debentures in the new company, and for outstanding accrued interest, equity shares of an equal amount are issued at par. This is a part of your net assets working. Trade payables are paid by issue of 12,000 equity shares at par in full and final settlement of their claims. Again, this is a part of my net assets. So our trade payables 12,000 into I think what is the par value? 10. So it is 1,20,000 in lieu of trade payables of 1,50,000. So there is a 30,000 gain possibly over here. Preference shareholders are to get an equal number of equity shares at par. Dividend on preference shares is in arrears for 3 years, and preference shareholders will forego the dividend for 2 years. For the balance dividend, equity shares of an equal amount are to be issued at par. So this will be a part of my PC. And equity shareholders are issued 1 equity share at par for every 3 shares held in Mohan. This will also be a part of my PC. So if I look at equity shares, there are I think 30,000 equity shares. So 30,000 equity shares, you have been given the number 1 for every 3. And hence this will be 10,000 shares unless given otherwise at rupees 10, and hence this will be 3 lakhs. Other than that, for preference shares, you will get 6,000 ke samne 6,000, so that will be 60,000. And other than 60,000, you will also get for dividend on preference shares for 1 year 6,000 into 10 into 9%, 5,400. This is in the form of equity shares, but still it is a part of your overall PC. Current assets are to be taken over at book values, except inventory, which is to be reduced by 10%. Goodwill is to be eliminated, and PP is to be taken over at 3,08,400. So your PP will be taken over at 3,08,400. Current assets are at book value except inventory, which is to be reduced by 10%. So inventory over here will be 72,000. Other current assets at book value. So this is 1,10,000. This is possibly 20,000. अच्छा, ये 20,000 में से शायद you will have to. Okay, we'll see that. Goodwill is to be eliminated, so this will become 0. Okay. The remaining equity shares of the new company are to be issued to public at large at par fully paid up. Remaining equity shares, how will you find? Well, there is a total 40,000 equity shares. Against this 40,000 equity shares का जो total limit है, what have you done? You have issued preference shares, will get equal number of equity shares. So out of the 40,000 authorized, I can say 6,000 are issued to preference shares. Dividend on preference shares in arrears, we will give equity shares worth 5,400. No, so I think 540. Equity shares of rupees 10 each. Equity shareholders will be issued another 30,000 shares. 30,000 के सामने 10,000 shares. And then you have these trade payables. To them, I'm going to issue 12,000 shares to the trade payables. And hence, how much is the remaining shares? 40,000 minus 6,000 going to preference shares, 540 going for preference dividend, 10,000 going to equity shareholders, and 12,000 going to trade payables. And hence, I think 11,460 shares to be issued at the rate of rupees 10 each. Bank account debit to equity share capital 1,14,600. Expenses of 5,000 are to be met from the bank balance of Mohan. This is to be adjusted from the bank balance of Mohan before acquisition done by Ravi. So over here the bank balance that will be taken over will be 15,000 after adjusting acquisition expenses. Okay. So after this, interest payable on debentures, what have they told you? Acha, for outstanding accrued interest, equity shares of equal amount are also issued at par. So this is 20,000. So that is settled by issuing 2,000 shares of rupees 10 each. यहाँ पे और एक less हो जाएगा, another 2,000 less, and hence this will be 9,460 shares of rupees 10 each. Debentures के सामने new debentures, so this will now become 0. Even trade payables are fully settled, will become 0. This will also become 0. Debentures, same 2 lakhs worth of debentures will be there. Okay. So when you look at question number 20, your purchase consideration will have for preference shareholders 60,000, for their dividend 5,400, and hence 1 lakh for equity shares, totaling to 165,400. Over here also we have said 65,400 and 1 lakh. This is 165,400. This is 30,000 into 1 by 3. That is 10,000 into 10. Okay. So this comes to 165,400. Now if I have to prepare realization account in the books, in the shareholders account, in the realization account, I will transfer all assets, all liabilities. Bank mein net 15,000 I will transfer. Debentures, interest, everything will be done. 165,400 ka PC jayega. And then we will have shareholders account. In the shareholders account, there will be 3 lakhs as well as P&L debit balance of 1,70,000. Now we will see if there are any preference shareholders. Yes, there are preference shareholders worth 60,000 to whom you are giving consideration worth 60,000 plus 5,400. So 5,400 extra that you are paying will be the loss. Will come over here. Realization expenses that are being paid will also come over here. Realization expense account debit to bank. And hence all said and done, there will be a 30,000 loss on realization and 1 lakh rupees worth of equity shares being given to the shareholders. We need to prepare the balance sheet. अच्छा यहाँ पे in the books of Ravi bank account में business purchase में in the books of Ravi I will take over cash balance of 15,000 plus I will have 94,600 on issue of shares, 9460 into 10. As we said, all said and done 9460 into 10. And then the balance of 1,09,600. Uske alava, we will directly prepare the balance sheet. So over here, finally, your equity share capital will be a total 4 lakhs into 40,000 into 10. This will be 4 lakhs. Your cash bank will be 15,000 plus 94,600. That is 1,09,600. And if I now were to total, P&L debit balance will not be taken over. So over here, you will have 4 lakhs, 2 lakhs. Remember, trade payables are paid off, outstanding interest is paid off, 2 lakhs worth of new debentures are issued. Assets जो भी है आपके 3,08,400, okay. 72,000 for inventory, 1,10,000 for debtors, and 1,09,600, and that takes care of question number 20. And by and large, a fairly quick, compact, and a comprehensive review for your amalgamation chapter. So a lot of these sums which are there, the more you practice, the better you get, but there is a bit of variety. You might get a question involving a purchasing company, you might get a question involving a selling company, you might have a merger method, you might have a purchase method, you might just be asked PC. So there are quite a bit of variety. You can do 2, 2, 3 sums for each of them for a better understanding, but this is a chapter on which a sum is almost certain to come in your exam, and hence this is important. I hope you are clear with amalgamation. So that should be it, and we'll see you soon with another topic. Till then, keep studying, do well, and keep your spirits high. Bye bye, take care.